Okay, you should be good to begin.
Okay. As chair of the House Ways and Means Committee, I find that due to the state of emergency declared by the governor as a result of COVID-19 pandemic, and in accordance with House Rule 67 and the governor's emergency order number 12, pursuant to Executive Order 2020-04, this public body is authorized to meet electronically. This is a joint Ways and Means Committee economic briefing. Please note there is no physical location for members of the public to observe and listen contemporaneously to this meeting. However, in accordance with Emergency Order Number 1, I am confirming that all members of the committee and select legislative staff have the ability to communicate contemporaneously during this meeting through the Zoom electronic meeting platform. And the public has access to contemporaneously listen and, if necessary, participate in this meeting by the Zoom platform or by telephone. All necessary access information has been made available in the House calendar and through the electronic calendar on the General Court website. Notice for this meeting complies with House Rules RSA 91-A. Anyone who has a problem accessing the meeting should call 271-3600 or email hcs@leg.state.nh.us. In the event the public is unable to access the meeting will be adjourned and rescheduled. I want to introduce the staff that are on the meeting assisting us, which is Jennifer Floor and Christopher Shea from the Legislative Budget Office. Please note that all votes that are taken during this meeting should be done by roll call vote. Let's start the meeting by taking a roll call of attendance. When each member states their presence, please also state whether there is anyone in the room with you during this meeting, which is required under the right to know law. Thank you. Representative Bernstein, you want to take the roll?
Thank you, Mr. Chair. Good morning, everyone. Representative Abrami.
I'm at home alone. Thank you.
Representative Griffin.
Representative who?
Griffin, that's you.
Yeah, I'm present. I'm home alone at my home in Windham.
Okay, good morning, Mary.
Good morning.
Representative O'Leary.
I'm home. My wife's in the house someplace. And
Okay. Representative Ober. Representative Ober. Representative Doucette. Representative Doucette. Representative Burstein is your clerk. I'm in beautiful Nottingham, New Hampshire in my home office alone. Representative Elliott. Representative Elliott. Representative Janigian.
RG, Janigian.
Janigian, I'm sorry.
That's okay. You don't mind if I correct you. I don't, I'm fine. I'm here in Salem, New Hampshire with my wife and daughter somewhere in the house.
Okay, Representative Nunez.
Good morning. I'm present and I'm at home alone in Pelham.
Representative Baxter.
Thank you, Representative Burstheim. I'm here alone by myself at my home.
Representative Spilsbury.
Good morning, present at home. My wife's elsewhere in the house in Charlestown, New Hampshire.
Representative Tudor.
I'm here alone in my cellar in Northwood. Wife and grandkids are upstairs.
Representative Almy.
Home alone in Lebanon. Representative Almy.
Thank you. Representative Ames.
Yes, I'm here in Jaffrey in my home office alone.
Representative Southwood.
Representative Southworth, I'm home alone in Dover.
Representative Malloy.
Yes, I'm home alone in Greenland.
Representative Schamberg.
Representative Schamberg in Wilmot. My wife's in the home.
Representative Tucker.
Yes, I'm here alone in Randolph.
Representative Gomarlo.
Representative Gomarlo in Swansea by myself.
Representative Loftman. Representative Loftman. Representative Gorg.
I am here alone in my home office in Lee.
Representative Hacken Phillips.
Present this morning, alone in my office in Concord.
Representative Murphy.
Present here in Hanover. My wife and daughter are elsewhere in the house.
Representative Major.
I'm here in my home with my wife in the other room in Plaistow.
Senator Gary Daniels.
Senator Gary Daniels, I'm at my home in Milford and I'm alone.
Senator Gaida.
Senator Gaida, at my home in Warren, my daughter and grandson are in a remote part of the house.
Representative Hennessy.
Senator Aaron Hennessy, I am at my home in Littleton and my children are in the house with me.
That's Senator Hennessy.
My apologies, Senator Hennessy. Senator Rosenwald.
Cindy Rosenwald from Nashua. I'm in my home and my husband is around.
Senator D'Alessandro. Senator D'Alessandro. Okay, looks like there's 24 of us here and 5 of us are absent.
Thank you, Representative. Okay, this morning, we'll start off with Jeffrey Schultz, who's the CFA director. He's an investment strategist and oversees capital market and economist researcher, contributing thought leadership on economic topics that is frequently quoted in the financial media, including the Wall Street Journal, CNBC, and CNN. He joined ClearBridge Investment in 2014 and has 15 years of investment industry experience. Prior to joining ClearBridge, Jeffrey was a portfolio specialist at Lord Abbett and Company, LLC. He received his BS in finance from Rutledge University. Is a member of the CFA Institute. Mr. Jeffrey Schultz.
Thank you, and good morning, everybody. So my name is Jeffrey Schultz, and I'm the investment strategist with ClearBridge, here to give you an update for what we expect to happen here in 2021. I'm in the process of trying to share my screen here, but it does appear that I am unable to do so. We'll be able to share my screen to show you some slides on what we anticipate here for the economy.
Jen, can you help?
I just updated the setting. My apologies.
All right. Thank you very much. Full screen mode. Okay, so obviously after 2020, there's a lofty expectation for 2021, and I think those expectations will certainly be met. For the narrative throughout the course of last year, though, we were really focusing on whether or not we had seen a durable economic and market bottom in the U.S. And the way that we've been able to do this, sorry about this, the way that we're monitoring this was with our proprietary recovery dashboard, a group of 9 variables that have done an excellent job of foreshadowing a durable economic and market bottom. It's a reverse stoplight analogy. So the goal here was to go from a red recession to a yellow improvement, ultimately to a green expansion color. And you can see the entire progression of the dashboard over the course of 2020, where the dashboard is flashing a red recession at the end of March as the US economy was going through shutdowns. As we transition to June, the dashboard is flashing a green expansion. At that point, we're advocating to our clients to upgrade and risk, take on more beta in their portfolios to take advantage of this budding economic recovery. And it's continued to get more green, if you will, throughout the course of 2020. But as it stands, as of year end, we have 7 green, 1 red, and 1 yellow signal. And I think it's really clear at this point that we have seen, in fact, a durable economic and market bottom. I'm not sure I'm going to get much pushback from the group here, considering that the S&P 500 was up 68% through the lows into the year end, and third quarter GDP came in at 33.4%. But if you think about that recovery, I think it was very interesting and dynamic in 2 specific facets. First off, earnings came in much higher than anticipated. In the second and third quarter of last year, earnings beats were much stronger than what you saw during the last recovery. In fact, it was the strongest earnings beats that you've seen since 1996. And looking so far here at fourth quarter earnings that have come out, it does appear that analysts are underestimating the earnings potential for the S&P 500 yet again, and it's going to surprise to the upside. Now, the earnings came in much better than anticipated, obviously because companies cut costs very dramatically and quickly. But the other half of the equation was that you saw an economy come on very strongly. And the big question in the middle part of last year is what was the shape of the U.S. economy's recovery going to be? And against consensus expectations, it ended up being a V-shaped recovery. And this is best illustrated through retail sales. It only took 6 months for retail sales to recover their pre-recessionary peak during this recent crisis. You compare that to the dot-com bubble, it took much longer at 16 months. And then the global financial crisis, it took almost 3 years. But if you look over at retail sales on the left-hand side, which is that red line, you can see that it's hooked down here recently. In fact, you've seen negative retail sales prints on a month-over-month basis for October, November, and December. And a key reason for that, obviously, is the COVID-19 crisis that the US is currently dealing with. You're seeing social distancing measures come back into place. You're seeing economic retrenchment. In fact, in 29 US states right now, you're seeing some form of restrictions on indoor eating. But there is a key difference between today and March. When you saw a large increase of cases, you saw a subsequent increase, large increase of deaths. This time around, even though cases have spiked dramatically, deaths have only moved up a fraction of what you saw earlier in the year. And it's a key reason, obviously, why the US economy has continued to remain open, much more so than what you saw at the end of the first quarter. But nonetheless, because of COVID and the increase of hospitalizations and deaths, you are seeing economic retrenchment. And you're not only seeing it slow down in retail sales, but you're also seeing it in the labor market as well. Now, the latest jobless claims print that we got last week jumped up to 965,000. Consensus expectations were for that jobs print to come in below 800,000. So that's a huge spike. And at 965,000 job losses in a week prior to COVID, that would have been the largest weekly job loss in US history. So you're seeing pronounced weakness in the labor market. You're also seeing it with the monthly jobs reports. We got a December report a couple of weeks ago. It came in well below consensus expectations at negative 140,000. That was the weakest jobs report outside of March and April that you've seen since the global financial crisis. And it has a lot of people wondering whether or not this is just an economic slowdown or whether or not this is a double dip recession. And because of that, we've reintroduced our recession risk dashboard, a group of about 12 variables that have done an excellent job of foreshadowing whether or not a recession is on the horizon. It's a stoplight analogy, but it's in the reverse this time, where the goal is to go from a green expansion to a yellow caution, ultimately to a red recession. And as of the end of December, we have 7 green, 3 yellow, and 2 red signals. But most importantly, if you look at the bottom of that first column, you have an overall green signal, which tells us that this is just a slowdown. This isn't a double dip recession. And if you look all the way to the left of the chart, we really try to look at the economy on the 3 fault lines of economic activity. At the very top there, we're looking at consumer health. It's the biggest part of the dashboard because it's the biggest part of the US economy. Below that, we look at business activity. Obviously, businesses are responsible for hiring and doing CapEx, both of which have a multiplier effect on economic activity. And then last but not least, at the bottom there, we're looking at financial stresses, because financial stresses usually emanate first before the economy rolls over. And I want to turn your attention to the financial stresses section. All 3 of those indicators right now are flashing a green expansion color. This shouldn't be a surprise to anybody, because if you look at the Goldman Sachs Financial Conditions Index, it's the most accommodative in the history of that series. So there's a lot of liquidity squashing around in financial markets. But the other one I want to point out is the second one under business activity, which is ISM Manufacturing PMI New Orders. If you're not familiar with manufacturing PMI, all it is, it's a survey given to manufacturers asking them how business conditions are and also how business conditions look to be in the future. The most forward-looking component of that survey is the new orders component. And manufacturing PMI New Orders is synonymous with the business cycle. When it accelerates with a 3 to 6 month lag, the US economy generally accelerates. When it decelerates with a 3 to 6 month lag, the US economy tends to slow. And ISM Manufacturing PMI New Orders came in at a very strong print in December at 67.9, which tells us, even though you are seeing some weakness in the labor markets, that this is transitory and the economy is going to be able to power through this. The other thing I'll mention about that jobs report that we got for December, the headline number is very negative at a negative 140,000 job losses. But if you look beneath the surface, I look at that as a very strong jobs report, because hospitality and leisure job losses over the course of the month were 498,000. And it's not surprising that you're seeing massive job losses in those sectors, given the fact that you're seeing economic retrenchment and a return of social distancing. But if you strip that cohort out, the jobs report was a very healthy 350,000, which shows you that the underlying strength of the US economy is resilient and the underlying economy is fine. And once you get to the middle part of this year, a lot of those job losses that you're seeing in hospitality and leisure will come back as the economy gets back to normalization. Now, the other thing I'll mention, obviously, whether or not this is a slowdown or a double dip recession, we're clearly in the slowdown camp. And there's a couple of reasons why. Not only that the dashboard is flashing a green expansion color, but also that the US economy is going to reach herd immunity sometime in the second quarter or third quarter of this year. In fact, if all the vaccines that are expected to come online do, you're going to have 5.1 billion shots administered by the end of 2021. But US economic activity is going to start to accelerate well before herd immunity, because as you start to inoculate frontline workers and also the most vulnerable and community type living types of situations and the elderly, you're going to see a decrease of hospitalizations, you're going to see a decrease of deaths, and economic activity will naturally start to increase at that point. But also, even though the US has stumbled out of the gate with their inoculation efforts, you have started to see an increase closer to that 1 million shot per day level that was anticipated as we moved into December. So I feel by the end of this month, we're going to be reaching those levels. We're going to be well on our way to reaching herd immunity. But once you reach herd immunity, this is a key determination of trying to unlock a lot of the consumer savings that have built up since the beginning of the pandemic. In fact, since the beginning of the pandemic, you have total excess savings on the consumer balance sheets of $1.4 trillion. That's not including the stimulus package that was passed in December with $600 checks going to every American. That qualifies. It doesn't include the likely additional stimulus that's coming out from the Democratic package that was released here recently. Obviously, you're probably going to see some additional stimulus going to consumers. So it wouldn't be a surprise to me if you see total excess savings north of $2 trillion by the middle part of this year. And I think once you get to that point, you're going to see revenge spending, deferred gratification. People are going to spend a lot on services and going to really juice economic growth in the back half of the year. And the one thing I think that's really different today versus the global financial crisis is people are accumulating savings, not because of caution on the part of households, but they're accumulating savings because they don't have the ability to spend on services because of mobility restrictions. And herd immunity will take away that hurdle and really unleash a lot of this capital. But this is one of the key reasons why we expect economic activity above consensus expectations for the next couple of years. Also, you're going to see a very massive inventory rebuilding cycle in the US. Inventory levels relative to sales have not been this depleted since 2014. But now that businesses finally have some visibility into the back half of the year, they're going to unleash a massive inventory rebuilding cycle in order to anticipate that future demand. And this is really going to boost manufacturing activity in the first half of 2021, I should say. The other thing that I think is going to boost economic activity is the macro trifecta. These three ingredients have been crucial for fueling strong economic rebounds. That's lower long rates, so a low 10-year treasury, weaker energy costs, and a weaker dollar. And if you look at low long rates and a weaker energy costs, they are much more depressed than what you've typically seen in an economic recovery. And this is going to provide a tailwind well into 2022. And it's clearly being reflected by consensus expectations. In 2021, it's expected to be the best growth in the US economy in over 20 years. But this just isn't a one-year phenomena off of easy comps because of the recession. In 2022, that's expected to be the best growth since 2004. And this does not include the stimulus that was passed in December and the likely new stimulus that's coming out over the next couple of months, which is why we expect economic growth well above consensus expectations of closer to 6%. And I think there's a key consideration here that I think market participants and policymakers are really underestimating the massive amount of savings that you've seen, not only on the consumer side, but on the corporate side as well, and what that's going to do to juice economic activity once you reach herd immunity. And I think obviously with policymakers underestimating that increase of activity, one of the key policymakers that I think are underestimating what the U.S. economy can grow at is the Federal Reserve. The Fed is clearly fighting the last battle, which is the global financial crisis. And they have their foot all the way down on the accelerator. And one of the ways that you can see this is through quantitative easing. Now, the United States has a much larger ability to do quantitative easing versus the Eurozone or Japan, given the fact that our balance sheet is much lower as a percent of GDP. But at present, the Federal Reserve is doing $120 billion worth of bond purchases per month. And they're going to continue to do that until they see substantial further progress on both the unemployment rate and inflation. And given the rosy optimistic outlook that we just talked about, again, 120 billion per month is a massive number. It's 1.5 times larger than any previous QE program that we've seen in the US. But also, they're not only just doing QE, they've actually changed to an average inflation targeting regime. And the key reason for this is because they've woefully missed their 2% inflation target since 2008. At the very top of the screen, you can see that they've only hit that 2% target 3 times over the last 12 years. So in order to fix that, they're going to make up for that shortcoming, and they're going to let inflation run hot over 2% for a prolonged period of time. And the two things that they're really looking for in order to start raising rates is they want to see the unemployment rate back to where it was prior to COVID-19, which is 3.6%. And they want to see inflation sustainably above 2% for a period of time. Now, looking at the Fed's dot plots, which is what their expectations are for the unemployment rate and inflation, it goes out to the end of 2023. And at that point, the Fed expects the unemployment rate to be at 3.7%, which will be close to the target that they've outlined. But they only see inflation being 2% at that time. So from the Fed's vantage point, they don't see themselves raising rates until 2024 at the earliest. And this is a really important consideration because usually the Fed has their fingerprints on most recessions as they start to raise rates in anticipation of inflation. They usually raise rates a little bit too much and end up causing a recession. This time around, the Fed has recognized that raising rates too early is more detrimental to the US economy than raising rates later. And they're not going to get in the way of this economic expansion that we have in front of us. And they're going to let the economy run hot over the course of the next couple of years. Now, this is a very important backdrop for the economy and risk assets. But one of the things that I think is an important consideration here is that the two recoveries that we have today versus the global financial crisis couldn't be more different. First off, one of the big differences is the origin of the recession. This recession that we recently had was caused by an exogenous event, and the economy was in a fairly good position and a very fairly strong position as the economy shut down. Back during the global financial crisis, you had pre-existing conditions with an overheated housing market, an overextended consumer, and bank leverage issues. And it really took 3 or 4 years to work out those issues before the economy can start to accelerate and heal on its own. And we just don't have that overhang this time around. The second difference is the policy prescription today was exactly the right one. Policymakers came out forcefully and aggressively. They got businesses and consumers access to capital in a fast and efficient manner. Back during the global financial crisis, it took a long time to calibrate the right policy response. And because of that, you had longer and deeper scarring last cycle. And the other difference is the health of the average household. Households are in very good shape because of a strong housing market. Financial markets are up substantially from the lows. Obviously, you've had an abundance of fiscal stimulus and the inability to spend. And versus the end of 2019, household net worth is up $5.2 trillion. That's going to go a long way to helping this recovery unfold over the next couple of years. But maybe the biggest difference between the two recessions and recoveries is found in the labor market. Now, what we're looking at here is the NFIB Small Business Hiring Plans Survey. And if you're not familiar with the NFIB survey, it's the premier small business survey. It took until 2014 to regain pre-recessionary levels coming out of the global financial crisis. Today, we've already recovered it in less than 9 months. Looking at US job openings, it's a similar situation. It took until 2014 to get back to pre-recessionary levels, where today US job openings are where we were as we went into COVID-19's crisis. And this is a very important consideration, because if you have a lot of job openings out there, that means that you can see a labor market that heals much faster than anticipated and much faster trend economic growth. And this crisis, 77% of the job losses were in COVID sensitive industries. And as we reach herd immunity and we get to some level of normalization, again, these are going to be jobs, and the job creation in that industry is going to happen much quicker than what we saw just a decade ago. You're also seeing a difference in confidence. Again, this is the NFIB survey, which is that premier small business survey in the US. Took until 2014 to get to pre-recessionary levels. We're already at that point currently. And if you think about one cohort that should be hurting the most from the crisis, it's small businesses, because a lot of their business models rely on face-to-face interactions. And with social distancing and economic retrenchment, it's hitting small businesses the hardest. But clearly they are they're very confident, even in light of the economic slowdown that we've seen here recently. You're also seeing it in the CEO Roundtable Business Confidence Survey. Again, we're at pre-recessionary levels there. And if you have business confidence, that means businesses will invest in the future. They're going to do CapEx, they're going to hire. Of course, that all has a multiplier effect on the economy. You're seeing business confidence in a different way as well through business formation applications. Back in the global financial crisis, not surprisingly, you saw business formation applications plummet all the way through the crisis and even through the first year and a half of that recovery. This time around, you're seeing business formation applications skyrocket. They're up 25% year over year. And again, it's creative destruction. This bodes very well for the next couple of years of economic growth. The last difference in the two cycles is really from a demographic perspective. And one of the most underrated reasons of why you saw slow growth during the last decade was from demographics. And those headwinds were coming from two distinct areas. On the right-hand side of the chart, you saw a huge increase of baby boomers that were exiting the workforce, a huge increase that the US economy has never seen before. And as people retire, they spend and earn less. That's a headwind to economic growth. But also in the middle of the chart there, you can see that boomers exiting their prime spending and earnings years, which happens to be ages 35 through 54 in the US, they were being replaced by a much smaller Gen X, which means fewer individuals entering into those prime spending and earnings years. You fast forward to today, instead of having a demographic headwind, you have a demographic tailwind. And it's really similar to 1994. Now, in the middle of the chart there, you can see that millennials entering into their peak years is going to be a tailwind to economic growth in the US well into the next decade, really over the next 15 years. You have more and more millennials spending and earning more. But the demographic tailwind is going to be less than what we saw in 1994, because if you look on the right-hand side of the chart, you have a lot more baby boomers heading into retirement today versus what you saw about 25 years ago. So taking a step back and talking, about what the core conclusion is here, is that this is a very different setup than what we had coming out of the global financial crisis. It's a different cause of the recession. You don't have any economic overhangs like you had back in the global financial crisis. The policy prescription was right, so you had less economic scarring. Households are in a very strong position to continue spending. Labor markets are in a very good position today. Also, you have broad-based confidence, and demographics are going to be helpful to economic growth. And this all is in a backdrop when the Fed is not going to take the punch bowl away from the party, and they're going to remain very accommodative well into this recovery, which is not the traditional experience that we've seen. Now, one thing I'll mention is there's a lot of people that are concerned about valuations at the moment. With the forward PE of the market at 22.5, you've only seen this eclipsed back during the dot-com bubble. But one thing I want to mention here is you can't look at valuations in isolation. Valuations today should be different than what you see valuations in 1980 versus 1950. And the reason why I say that is for a number of different reasons. First off, the index composition of the S&P 500 has been different over the last 100 years. And in order to illustrate this, what we did is we looked at all of the cyclical areas of the market, which are financials, industrials, materials, and energy. We've bracketed them together, and that's the dark gray line that you see in front of you. And then we bracketed all your growth, stability, and defensive sectors together, which is the blue line there. And traditionally, cyclical sectors are awarded lower PE multiples because they have huge swings in their earnings potential based on economic activity. And your growth, stability, and defensive areas of the market are usually awarded higher PEs because they usually have a high degree of earnings visibility, they have moats around their business, or they're growing much faster than the index overall. And as of today, cyclical representation of the S&P 500 is at a 100-year low at 23%. So the average PE of the market has been 16. Given this less cyclical representation in the S&P 500, maybe it should be a couple of turns higher. The other reason why valuations should probably be higher today versus history is because interest rates are low. And in fact, as of the end of the year, 49% of the S&P 500 had a dividend yield greater than a 30-year treasury. So if you think about interest rates, one of the key components of evaluating stocks and the earnings of a stock is interest rates. And if you have a lower discount rate, all things considered, you should have a higher P multiple to pay for that dollar of earnings. The other thing that I'll mention right now is usually at this point in the cycle, stocks look expensive because as you come off of recessionary troughs, usually PE multiples skyrocket as the market anticipates future earnings growth and the market grows into that earnings expectation. So if you look at off of the trough of the tech bubble and the global financial crisis, almost in the entirety of the S&P 500 returns during those first 9 months was from PEs expanding. But as you move to the 12 months following that point and the 12 months following that point, so the next couple of years, the baton hands off to earnings and they really drive the market forward in those subsequent years. And you actually see PE multiples decline in years 2 and 3 following an economic trough. Putting this all together, how stretched are out valuations? Well, if the historic PE is 16, you take sector mix impact into consideration, the lack of cyclicality, maybe historic earnings should be 1 turn higher versus history. If you take low interest rates into consideration, it should be 2 turns higher versus history. Considering the robust earnings backdrop that we have in 2021 and 2022, 1.5 turns higher than that. And then in that other bucket, that's a number of different considerations. Free cash flow generation is much higher versus history. You have higher margins as well. And this also is a over or under valuation versus what fair value should be. So if you put this whole waterfall together at forward PE at 22.5, today, maybe 21.5 is fair value given all of these dynamics that we talked about. So this isn't the dot-com bubble 2.0. There's a key reason why you have valuations at these current levels. And again, given our above consensus expectations for economic growth, we think earnings could surprise to the upside next year. The last thing I'll mention here is usually if markets have moved a long way off of the trough. A lot of people think that there isn't more upside for the S&P 500, but this is not the way that we're thinking about things. In fact, we do think that the S&P 500 has a lot more upside for the rest of this expansion. So we looked at the S&P 500 from the start of every economic expansion since 1970 and what it returned to the start of the next recession. We're not looking at the market trough, which happened to be March 23rd, but the start of the economic expansion, which we don't know yet because the NBER has not designated when the recession ended. But from our estimation, we think it's probably going to be June. So this is looking at it really from July 1st through the end of this expansion. And if you look at that blue area there, the average move higher in the S&P 500 is 96%. But if you look right below that, the average move higher in a secular bull market is 149%. And one of our core views, and it's that we are clearly in a secular bull market in the US. And if you're not familiar with the term, usually US financial markets go through a 10 to 20 year period where they go nowhere. That's better known as a secular bear market. And they're followed by a 20-year period where the markets go up substantially, better known as a secular bull market. So in the 30s and 40s on the left-hand side, you can see there's a pretty substantial secular bear market. During those 2 decades, your cumulative return was negative 22%, but that gave rise to the secular bull of the 50s and 60s. Return jumped up to 450%. Of course, that gave rise to the secular bear of the 70s with high inflation. Returns were roughly flat, followed by the secular bull of the 80s and 90s. Return jumped up to 1,250%. And it's our view, and it continues to be our view, that we exited the secular bear of the 2000s. We're now in year 11 of 20, where you're going to see outsized equity returns. Obviously, doesn't mean aren't going to have bumps in the road or recessions, because we clearly just had one. But if this trend continues, which has been going on for the last 90 years, there's going to be a lot more upside for U.S. equities as we move through this decade. And everybody always asks what's going to propel this secular bull market higher. I think it's clear that this is a different recovery, and the Fed is not going to get in the way of that recovery in the near term. So it's going to be really good for risk assets. Also, I think there's a clear difference that the baton has moved handed off from monetary policy to fiscal policy. If you think back to the last recovery, even though monetary policy was very aggressive, fiscal policy was a little bit more restrictive. There was a lot of austerity measures. This time around, both fiscal policy and monetary policy are rowing in the same directions, which is going to be a powerful force. And then lastly, I think you're going to see a lot of investors move towards dividend paying equities for income and growth of income in this low rate environment. So, maybe to sum everything up, even though the markets have moved a long way off of the lows, we do think that there's some more upside from here. Valuations look expensive, but if you take low interest rates into consideration, sector mix, and the expectations for strong earnings over the next couple of years, I think these valuations are justified. And then also, I think economic growth is really going to surprise on the upside because of all those differences that we talked about with the global financial crisis, but also consumers will likely have $2 trillion in excess savings to be able to fuel that recovery over the next couple of years. So with that, maybe I can turn it back to the audience to see if you guys have any questions.
Thank you, Jeff. That was very stimulating. A lot of good information. Now we're going to get to be able to use these charts, I hope. My question is this. Our biggest source of revenue in this state comes from business taxes. And we have to project revenues out for a 2-year period starting July 1, 2021. What would you say that the GDP or the growth of businesses will be on average over these two years starting July 1, 2021?
Yeah, I think most businesses that were going to go out of business probably will over the next 6 months. But I think given the business formation trends, I think you're going to see an acceleration of number of businesses that are going to be in the state, but also the amount of revenue that you're going to see. And given the expectation for above trend growth, 6% real GDP growth is probably closer to 8% nominal GDP growth. I would expect a huge bump in business taxes over the next couple of years, somewhere in the tune of, call it 6 to 8%, all things considered.
Wow. Thank you. Okay, questions from the committees? Let's see. Representative Yurley.
Thank you, Mr. Chair. I've got several questions actually, but let's begin with the ones you talked about. One of the driving forces of the economic growth over the last decade has been weaker energy costs and a stable wage environment. If the government starts to play with these things, either the federal or state level, what would be the effect? You've got a crystal ball in front of you, so you just have to ask it and get the answer right away. What would be the effect on our economy? Would it go up? Would it go down? Would it remain the same? That kind of thing.
Yeah, so one of the obviously the key tenets of Biden's agenda is a higher minimum wage of going to $15. That would obviously be stimulative on a state level for payroll taxes, and from a federal level from payroll taxes, it would also bring down, obviously the bottom line for a lot of small businesses. I say the net effect is probably neutral. It's just, it's going to be labor that gains more share versus capital in that instance. So I don't necessarily see a big difference there. Also, as far as wage growth is concerned, if you aren't able to pass a higher minimum wage tax, I see wage growth remaining relatively stable over the next couple of years because the unemployment rate's at 6.7%, which means there's still quite a bit of slack left in the US economy. Usually you'll start to see wage growth percolate higher when that gets closer to 5%. So again, I don't see a huge effect one way or another with that higher minimum wage if it does go into effect at a federal level. And then your other question was minimum wage, and then I forget the other half. of it.
Energy. Costs.
Yeah, so there's a lot of supply out there with the energy on the energy front. Even if you do see restrictions on being able to frack on federal lands, shale producers right now are really just trying to generate free cash flow rather than growth at all costs, which is a key difference from the model that they had really through the beginning part of that last decade through to 2016. Also, the global supply, there's a lot of oil out there right now. And you're going to have until you can get to a full global economy to be able to get back to normalized levels of demand, which is around 100 million barrels per day, you're going to continue to see energy costs kind of languish here in the $50 or $60 range. You really got to see a return of air travel to get back to normalization before you could see energy costs at $70 or $80 a barrel, because jet fuel accounts for about 7% of global global oil demand, all things considered. So I don't see, anything changing on the energy front. I think oil is going to be pretty well pinned in this $50 to $55 barrel range over the next couple of years, regardless of regulations and, some regulations on frackers here in the U.S.
Follow up, Mr. Chair.
Just one, because we have about 8 more people to ask questions. Go ahead.
I saw that. And the follow up is, you also talked about a growing savings. Well, that's common folk, 1.5 trillion, heading towards 2 trillion you anticipated. Do you believe that there will be an attempt by the government to recoup some of that money for their own coffers?
I don't. I think it would be very difficult to be able to do that. Especially, if you look at governmental actions here recently, you had that $600 stimulus check that went out in December. There's talk of making that another $1,400 stimulus check. So they're clearly seeing the savings rate, but they do recognize that there's a lot of lower and middle income individuals and households that are going to need those checks in order to get through the first and second quarter until you could get to some sort of normalization. So I actually don't see a situation where the government will try to recoup that money.
Thank you. Representative Ames.
Thank you. And thank you for the presentation. It was really excellent. Encouraging, I would say. The assumption in there, or at least one of the points you made, was that that we'd reach herd immunity sometime in the second half, early part of the second half of this year, as I understood it. And I've seen other forecasts on that score that put it out another year, actually. And so my question really is, what difference does that make to your forecasts? So suppose the supply of vaccinations doesn't gear up, there are other snags, whatever, in the vaccination process, and we don't come to herd immunity until mid 2022. What then?
Yeah, I ratchet my economic growth expectation down dramatically. You're going to see a lot more pain in the services sector, a lot more bankruptcies. But I would anticipate, if that was indeed the case, that you would probably have more stimulus coming out of Washington over the course of 2021 to be able to stem the tide until we can get to herd immunity. But from all the projections that I've looked at here recently, I would imagine at the latest herd immunity coming in at the end of the third quarter. I think one of the bigger obstacles is, giving the American public, some people have some reluctance on taking a vaccine given the quick timeline that these have been coming out versus, the traditional 5 or 10 years that you've seen from a vaccine perspective. But as long as the vaccines that are in commercialization come to commercialization, and what I'm really looking for is Johnson & Johnson's efficacy data. If Johnson & Johnson can get through the FDA, the hurdles of coming to commercialization, I think herd immunity will be reached sometime in the third quarter, because they're going to be the one that could bring the most doses online, not only for the U.S., but for the global economy.
Thank you.
Representative Ronnie.
Thank you. Great presentation. I just want to follow up on Jordan's question a little bit more. Let's talk about a few other issues that may change things, philosophies that may change number one, regulation on business, but two, more importantly, is the tax increases potentially, especially business tax increases in areas that have incentivized companies to come back to America. Can you just touch on that a little bit?
Yeah, obviously, to be able to pay for the most recent stimulus package, taxes are going to have to rise. I do think businesses will bear the brunt of that. I would imagine the corporate tax rate moving back up to 25, 26% from 21% currently. You can see higher taxes on cap gains. I could see that going up to 25, 26% as well. I think the top income bracket will move back to where it was prior to the Trump tax cuts at 39.6%. But again, I think those are really going to be the only key taxes that come into play here. I know the headline number for the new stimulus package is 1.9 trillion. I think that number is going to come drastically down, probably into the $1 trillion range. Again, the key here is, given the fact that the U.S. economy is in a precarious position here, you're seeing a deceleration of labor market activity. I think these tax increases probably come into effect in 2022 because obviously you don't want to derail the budding recovery that we have right now. So overall, I do see higher taxes. I do see higher taxes, especially for a lot of your companies that have overseas tax shelters. I think big tech, for example, is going to see much higher taxes. But overall, corporations are in a better position today, even with these tax increases, than when they were going into the Trump tax cuts that happened back in 2017. So net, obviously, it'll be reflected on the financial markets. You could see markets go down about 5 or 7% to price in this new tax reality. But again, given the robust economic backdrop that I've outlined here, I think businesses are going to be able to overcome this momentary increase of their tax liability and their pressure on their margin structure.
Representative Southworth.
Thank you. Great presentation. I wondered, are there things that you really feel are specific or unique to New Hampshire? It seemed like last time we were one of the last New England states to kind of bounce back.
Yeah, you guys are number one. One of the number one drivers of the economy is smart manufacturing. I think that's going to be a theme throughout the course of the next decade. So I think New Hampshire is well positioned on that front as well. So I think you guys are well positioned to be able to thrive over the next decade because of that core competency and that leadership that you have. That's one of the things that we looked at prior to the call, and I think it's going to be a key differentiator for your state versus others.
Thank you.
Representative Janigan.
Thank you, Mr. Chairman. Nice presentation, Jeffrey, very informative. Just to build on Representative Abrami's questions, I had the same questions, but I guess when you talked about the next decade being pretty strong, I'm assuming you've already put in the fact that you believe taxes will be higher, regulations will be more intense. So when you talk about that, you're already planning for that.
Yes. Yeah.
Okay. Thank you.
Representative Almy.
Thank you. I'm wondering about something fairly different. On the business taxes are our biggest taxes, but we have a wide range of other consumption taxes in this state that affect mostly the middle class. And how far down does ownership of these savings go at this point in the structure of incomes? Or are we looking at a bifurcated economy?
It's a great question, and I think you've hit the nail on the head. For most of the stimulus packages that have come out, lower income households have spent a majority of those this fiscal stimulus that has come out. Middle class has saved, more than the lower income households, but it's really the top decile that has saved the most. But nonetheless, given this fact that you have roughly $2,000 going to each American that qualifies over the course of the next year, assuming that the package that's been put out with the Democrats goes into effect, that's going to go a long way to really juicing up the savings rate for low and middle income houses. So I think you're going to see a boom in your state, regardless, even if it is more middle income than lower or high.
Senator Geider. Bob, you have to unmute. Bob, you need to unmute yourself. Okay.
There we go. Thank you, Mr. Chairman. From the point of view of prognostication, would it be appropriate to say that we could be moderately conservative for the first of the 2 fiscal years for which we're preparing a budget, and somewhat more, for lack of a better word, exuberant or certainly positive as far as revenues to the state in the second year of the biennium?
Well, I think it all comes down to, how much economic retrenchment you see over the course of the first and second quarter here, right? If you continue to see the virus caseload increase, which we've gotten through the holiday season, I would imagine that you're starting to see a plateau of cases and they'll start to come down, and economic activity starts to accelerate meaningfully at the end of the first quarter, which is my expectation. I think you don't necessarily have to be more prudent year one versus year two, but if you do see cases continue to increase, post holidays as we get into February and March, again, that may be a better way to approach it. But I just, based on my expectation right now, I think both years are going to be very strong economically speaking, and I don't necessarily think that you have to be more prudent year one versus year two at this point.
Thank you.
Representative Tucker.
Took my hand down.
All right, then Representative Baxter.
Thank you, Mr. Chair, and thank you, Jeffrey, for your presentation. I just wanted to follow up on your comment about the minimum wage and it being neutral for the economy. The CBO released a report about 6 months ago saying a $15 minimum wage would cause about 3.7 million job losses. So especially in New Hampshire, where 90+% of the employers are small businesses, isn't it more likely that that's going to have a more negative effect in New Hampshire?
Well, yeah, if 90% of the businesses are small businesses in the state, yeah, I think that would probably be net negative. But again, I think given the fact that you do have so many job openings out there at this given moment, this early on in the recovery, even if you do see job losses that are substantial with your lower income individuals, I think that they'd be able to assimilate very quickly back into the labor force, given the fact that there is quite a bit of slack there, but there also is a very large need for labor at this given moment. But yes, I would imagine if you go to a $15 minimum wage, you're going to see automation in a lot of small businesses where you can do that, which would eliminate a lot of those the lower paying jobs that are out there. But net, I do think that you would see a rebound in the labor market fairly quickly should that come to fruition.
Thanks for your feedback.
Okay, Representative Southwood, you have your hands up again. Representative Southworth. Then Representative Alney.
I'm sorry, but I think that our hands didn't get taken down.
Okay. Any other questions? I don't see any further questions. I mean, this has been a perfect presentation for what we need at this point in time. You brought in the mix of the effect of the pandemic, which is a big unknown. You told us that if it's looking like the injections are going to happen, and what happens if we can meet 1 million a day, and what that'll do with the economy. And you've given us an idea of what if it doesn't do that. So we appreciate that. So there's been no further questions. We thank you very much.
Thank you for having me on.
Yeah. All right.
Representative Major, there's a hand up on the attendee side. I didn't know if you wanted to take that
sure.
since we have a few minutes.
I'm sorry. I didn't see that. Can you bring that up for me, Jen? Because I don't see them.
It's Joe G.
Morning, Norm. This is Joe.
Oh,
Gibbons.
yeah, okay, Joe, go ahead.
How are you? Jeffrey, I want to thank you for helping us in this situation. I did have one question. There's been a move in the price of the 10-year Treasury. So, you know, the yield bottomed in the spring, and then, you know, around 50 basis points. And then in August, started to move from the low 50s, and now we're up at about, 1.10% on the 10-year. And obviously that has an effect on, businesses borrowing costs and also mortgages, et cetera, et cetera. Can you talk about that phenomena, how that might affect, the economy, and also the Fed's, inability to control the broader bond markets, please?
Yeah, it's a great question, Joe. So obviously the 10-year has moved up 60 basis points roughly from the lows. But if you think about other recessionary troughs and the recoveries that have happened, 10-year Treasury usually moves up closer to 1.5% to 2%. So even though 60 basis points is double from where we were back in April, for example, it's still low relative to history, and usually rising long rates or rising 10-year Treasuries will have a bite on economic activity around 12 to 18 months later. So it's one of the key reasons why I think not only 2021 will be strong, but 2022 will be strong, because again, at only a rise of 60 basis points, that's very moderate compared to what you've seen versus history. Now, if you're going to have GDP growth, real GDP growth at 6% this year, real GDP growth next year being close to 4.5 or maybe even 5, I think that the 10-year Treasury will start to creep higher over the course of this year. But you're not really going to feel the economic effects of that really until the middle part of 2022, maybe into the later part of that year as well. But again, it's very low compared to history. 10-year Treasuries are one of the biggest drivers of economic activity. And again, this is one of the core reasons why I'm fairly optimistic over the next couple of years. And speaking about the Fed and the response function, one of the key reasons why the 10-year Treasury hasn't moved higher is because they moved to that average inflation targeting regime, signaling that they're not intending to raise rates over the next 3 or 4 years. So, that's kind of tethering the 10-year down to these lower levels. But I think as you see the recovery unfold here, and it does come in more strong than consensus expectations, I would imagine that the 10-year Treasury is going to continue to melt higher over the course of this year, reaching maybe 1.75% by the end of 2021. But again, with that lagged effect, you're really not going to start to feel that economic bite until a year or year and a half later. And one thing I'll mention, Joe, is that the Fed can tweak their QE purchases if they wanted to. Right now, they're doing 120 billion per month, 80 of which are Treasury purchases. If the 10-year Treasury starts to rise dramatically from here, and it's getting a little disorderly, similar to the taper tantrum that you saw in 2013, the Fed can tweak the composition of those purchases to buy longer dated Treasuries in the 10-year and trying to cap that and keep them lower. I don't think there's any real reason for them to do that at this point, as long as the 10-year Treasury rises in an orderly fashion and you don't see a taper tantrum. I think the Fed will keep their asset purchases consistent with what they've been doing recently. But again, if it does start to move higher, and it's getting to the point where they're getting concerned that there is some concerns about debt issuance and the digestion of all the debt that's coming to the market this year, they probably will tweak that composition to keep longer rates lower for longer to help the economy and keep it stimulative over the next couple of years.
Okay, I want to say something here. Joe Gimmel is a vice president of Morgan Stanley, and he's been my financial advisor for quite a while. And it was Joe that was able to get Jeff to come in and make this presentation to us. I want to thank Joe as well as Jeff. Thank you.
Thank you.
So any further questions? If not, then we'll close this session and be on time to open the next one. And thanks, Jeff and Joe.
Appreciate it.
Being 10 o'clock, Our next presenter is Phil Sutton. Phil is a senior policy analyst at the New Hampshire Fiscal Policy Institute, an independent nonprofit policy research organization based in Concord. Phil researches New Hampshire budget and revenue policy, the economy, and how it relates to the financial well-being of the state's residents, and the health policy. He is a New Hampshire native who previously served as a performance auditor for the New Hampshire Office of the Legislative Budget Assistant. So Phil, it's yours for the next hour.
Thank you very much, Chairman Major. Thank you for the opportunity to speak to you this morning, and thank you to representatives and senators of the Ways and Means Committees. So I'm going to share my screen if I have permission to do that, which it appears I do. Thank you to Jen. And I hope everybody can see my screen. Can I get an acknowledgement? Everyone can see my screen, I hope.
Yes.
Okay, great. Thank you very much. So I want to talk to you today a little bit about New Hampshire's economy, how New Hampshire's economy is interacting with household finances and has in the past, particularly looking at some of that economic recovery from the last recession, from the Great Recession of 2007 to 2009, and what those might mean for state revenues as well. And I should say, if there are technical questions about particular slides, I'm happy to either take them or over the course of the presentation, or go back to them at the end of the presentation. Chairman Major, I'll leave that up to you, but I'm happy to be interrupted if there's a burning question about a particular slide.
Why don't we try that, and if it slows us down, we'll have to wait to the end of your presentation.
Okay, that's no problem. Whatever way you believe works best. So just to talk a little bit about the shock that we saw, the initial impact of the COVID-19 crisis, this graph shows New Hampshire's gross state product. So when we think about the national economy, you might think of gross domestic product or GDP. This is scaled down to the state level. What is the gross state product? And these are annualized numbers as well. So this is not, this is if the economy was the size that it was in each quarter, which is how the Bureau of Economic Analysis reports it. And these are inflation adjusted numbers as well. So you can see this graph shows the third quarter of 2010 to the third quarter of 2020, and that second quarter of 2020, where we saw that sort of initial impact of the pandemic, that the size of the economy in that quarter was about the same that it was in early 2014. So obviously a major setback in terms of economic growth in the state. However, we did see a rebound in the third quarter of 2020, a very substantial rebound in terms of the overall size of the economy, still back to about 2017 levels. These data will probably be revised over time, but I wanted to give you a sense of, in terms of the total size of the economy, what did the impact look like? And it was even a more dramatic impact in New Hampshire as it was around the country on employment. And I know you heard some from New Hampshire Employment Security yesterday. They dove into these numbers more than I will, but I wanted to provide a little bit of context relative to what we saw in the Great Recession of 2007 to 2009. You can see this graph goes back to 2006, and it's the recession is shaded there. The number of employed residents in New Hampshire, estimated through these surveys, did drop relatively significantly during the Great Recession, which of course was a major economic event. But if you continue to follow that orange line, you can see that between the March survey and the April survey, the estimated number of New Hampshire residents employed dropped by a little over 150,000 people. And that's very significant, including, especially given that we're talking about roughly 750,000 people employed who are residents of the state. Now, of course, there has been a fair bit of recovery. There's been a pretty dramatic recovery, really beating expectations that a lot of folks had early on in the crisis. And that is a positive sign. I do want to flag the civilian labor force line as well, that blue line that we see here. That's counting the people who are employed or who are looking for work, who are unemployed but looking for work, as defined by the Bureau of Labor Statistics. And here we can see that The civilian labor force has dropped. People have taken themselves out of the economy and out of the labor force, and that number hasn't increased as quickly. We have yet to see those December numbers for New Hampshire. That may tell us a little bit more. We saw there was in terms of the total number of people employed, there was a tick down in those December numbers nationally. We don't know what, at least I don't know yet what the New Hampshire numbers are at this point. Maybe New Hampshire Employment Security offered you some insight there yesterday. But you can see that civilian labor force number, if that stays lower, or if that takes a longer time to recover, that does have some implications for the economy. That's likely because there are a lot of folks who are, staying home to either avoid the virus themselves or to take care of children or older adults who might otherwise be in a different setting and be cared for in a different setting, but because of the pandemic, they haven't been able to be. I think there may be some folks who were engaged in the labor force, who lost employment, and who were either near or a couple of years into what they considered retirement age. Maybe they're lucky enough that they have the assets available to be able to retire. So there are questions in my mind around how many of those people come back, or how many have taken this job loss as the transition to retirement, if you will, because we have a fair number of people in New Hampshire who are in that sort of age bracket where that's a choice they may be making. Now, I do want to note that the shock to employment that we see here has not been evenly distributed across wage groups. So these are data that are based on private sector high frequency data that are looking at jobs, and particular jobs by wages. And these are data that are crunched by researchers at Harvard and Brown universities. And they are, in this graph, comparing what was employment in high, middle, and low wage work in New Hampshire in January relative to what it is. The graph goes through about mid-October. And here you can see that high wage work, which is that reddish line, high wage work did dip significantly, but recovered by the time we got to about late spring, early summer, and appears to be running a little bit higher in terms of the number of jobs that are high wage jobs available. Middle wage work, we could see, had a larger dip and a much longer recovery timeline, and low wage work is still down about 20%. And that suggests that people who were working in, for example, a low wage job or working several low wage jobs before the pandemic, so back in January, some of those folks may have moved to a middle or high wage job, but many of them are probably still looking for either one low wage job or a supplementary low wage job, and they're not finding as many opportunities because of what we see in terms of what jobs are available for them to enter into. So that these data anyway suggest that the economic impacts have been really uneven in terms of who's able to find employment and who's able to earn income from employment. And we see that a little bit as well in New Hampshire Employment Security data. They've done an excellent job crunching numbers for us on a weekly basis and publishing them in terms of where unemployment claims have come from on an industry by industry basis. And this graph shows you the initial claims, so the total volume of initial claims. This isn't necessarily continuing claims, so these don't always represent what's happening in these industries now. But these initial claims are in those green bars. These show the 6 highest initial claims totals by industry, pardon me. And the orange bars beside it show the average weekly wage in these industries that were paid in 2019. And the line across the middle is the average weekly wage for all workers in 2019 in New Hampshire. And here you can see that all the way over on the left, food services and drinking places has a very high number of initial claims, much higher than any other industry, and also a relatively low wage. Again, these are wages reported through New Hampshire Employment Security's census of employed workers. So these covered employment and wages, pardon me. It's called something different at the federal level. So that industry is an example of where we've probably seen a lot of people who were previously low wage workers who are still looking for work or unable to find work. Social assistance is another area where we see fairly low wages and a fairly large number of job losses. There are some other ones here as well that offer somewhat higher wages, but here are the industries that we've seen the biggest impacts. And these impacts have had a fairly significant impact, especially on low wage and low asset households. We can see that if we look at a survey that's conducted by the US Census Bureau, it's called the Household Pulse Survey. It's conducted in every state. The survey has changed a little bit over time, but as of the last survey that asked the question, which was in mid-July, close to half of households in New Hampshire had lost employment income between March 13th and mid-July. That's a very significant swath of households that lost some form of employment income that they would have been expecting potentially over that time period. About 1 in 3 households, looking at the most recent survey data or the mid-December survey data, about 1 in 3 households in New Hampshire indicated it had been somewhat or very difficult to pay for usual household expenses during the prior 7 days. Now, we don't have data that mirrors that exactly from the pre-pandemic era. The Household Pulse Survey is something that's happened only in 2020 and sort of post the pandemic impacting people's finances. But we do have some similar data that shows, that asks a similar question that I'll get to a little bit later, but shows that it's likely a lower number, a substantially lower number. And again, this is December, this is not April and May when we saw those sort of highest, the least amount of jobs. About a quarter of respondents expected a loss of household employment income in the next 4 weeks. And again, that's of mid-December. So that may that may show some anxiety around heading into the winter months and losing some of those employment opportunities that are dependent in part on being outside. And then 11% of households indicated they sometimes or often did not have enough food to eat in the prior 7 days. So again, suggesting that family budgets are being squeezed in a way that does harm their ability to be food secure. So those numbers all suggest that there has been a pretty profound impact, especially again at the low end of the income spectrum. We see that in Medicaid enrollment in New Hampshire as well. Medicaid, of course, is a state federal fiscal partnership a program that helps provide or helps people with low incomes and limited means generally access health coverage and health care. And here we can see that enrollment has increased relatively significantly in New Hampshire. It was declining as the economy was improving over the course of 2019. We get to the end of February and there were about 179,000 people enrolled in New Hampshire. And as of the end of December, the most recent numbers we have, it's gone up a little under 19% in terms of the total number of people who are enrolled in Medicaid. Now, there are certain eligibility criteria for Medicaid. The federal government has, as part of one of their earlier aid packages, has required that people not be disenrolled from Medicaid, even if they are no longer income eligible. However, we've seen this number continue to climb, and there was some research done earlier in the pandemic in Minnesota around how many people are enrolled in Medicaid because they are continuously income eligible or still income eligible versus how many people were income eligible, enrolled, and would no longer be income eligible in normal circumstances, if you will. And they found that actually was a pretty small percentage were the portion who were income eligible at one point and were still enrolled in the program, even though they wouldn't be under normal policy, if you will. So that suggests that a lot of this, I mean, obviously that's Minnesota and earlier in the pandemic, but that suggests that a lot of this is probably a lot of people who were near the income eligibility threshold before and had employment income that they no longer have. Now, of course, that's a program that helps make people more financially secure. Medicaid is. We've seen a lot of federal action that has really provided a very significant and very important income boost to the economy during calendar year 2020. So here, this graph shows personal income from different sources, from different sort of categories of sources. And I provided the 4 quarters of 2019 to sort of give you context as to what these swings look like. You can see in the second quarter of 2020, the green bar, which shows those net earnings from work, dropped quite significantly. But there were, in that orange bar, transfer payments that really did boost personal incomes. And those transfer payments include the federal enhanced unemployment compensation benefits, the direct aid to individuals, and for example, those $1,200 checks that were to provide relief to individuals. Those likely pushed that number positive, very positive relative to the prior quarter in the second quarter of 2020. In the third quarter of 2020, we see that net earnings from work did rebound. It didn't get quite back up to the levels that were lost in the prior quarter, but it did increase. So there are probably a fair number of low-wage jobs that are included in that gap between the drop that we see and the increase that we see in the third quarter. But we also see that transfer payments folded back a very significant amount from the prior quarter. And again, that indicates that a lot of those federal actions were designed to be temporary or were time limited, and that was then support the economy didn't have going into the second half of 2020. Again, these numbers do change, they are revised, and we'll see what the fourth quarter of 2020 looks like. But that boost to economic activity, or that boost to resources available to people in the economy, is an important action on the federal side, and is a difference from some of the things that we saw prior to during the recovery from the Great Recession. And let's go back and look at that a little bit and where New Hampshire sits in that recovery from the Great Recession. In the prior conversation, there was a little bit noted about this. So this graph shows the total gross domestic product or gross state product at the state level of the United States as a whole in green, New Hampshire in orange and labeled. You can see the individual years of growth labeled, and then the remainder of the New England states in blue. And this is all pegged to 2005, and inflation adjusted, so it shows the relative size of the economy. And you can see that New Hampshire actually took a little while to grow, coming out to have a faster economic growth coming out of the last recession. It lagged a little bit behind its New England neighbors and still is a little bit behind where the United States is. It wasn't really until 2014, 2015, 2016 that we saw that growth pick up. So again, it was a delayed recovery, and particularly a delayed recovery in New Hampshire. But the size of the economy was overall larger when you get to 2017, 2018, 2019. Certainly, in inflation-adjusted terms, the economy was bigger in New Hampshire than it was prior to the pandemic, the Great Recession. But that wasn't true for everyone's wages. This graph shows the deciles, really percentiles of different parts of the wage spectrum in New Hampshire. So the median wage is at that 50th percentile, and you can see the dollar figure from the 2017 to 2019 data is about $20.50 an hour. This shows the higher wages. So for example, the 90th percentile, only 10% of the wages are higher than that. The 10th percentile, only 10% of the wages are lower than that. This graph compares the inflation-adjusted 2004 to 2006 wages to the 2017 to 2019 wages. And this shows that, again, people who had consistently had middle wages or lower wages didn't see much growth in real purchasing power. It was about flat in terms of real purchasing power across that portion of the wage spectrum. Even after the longest period of economic growth that we've calculated in U.S. history. Calculations go back to the 1850s based on the National Bureau of Economic Research. So that suggests that there were a lot of people who weren't able to contribute as much to the economic growth that we were seeing because their purchasing power was lower than it was prior to the Great Recession, or only on par with it. And if you take these same data and break it out by year, it shows how many people, especially again, lower wage earners and middle wage earners, had years during the economic recovery where their purchasing power was diminished over time. And that likely slowed the economic recovery. Obviously, there's some interaction between what we see in sort of the top line numbers and what we see when we dig down into these numbers. But that likely slowed the economic recovery. Consumers are, 67% of all economic expenditures come from personal consumption. So if fewer people have the resources available to afford buying goods and services, that slows the economy, because that means there's less purchasing power among more people in that important part of the pie. So again, you can see here in green, the figures falling well below that 100 line, which is those inflation-adjusted wages, again, pegged to 2005. It wasn't until really in New Hampshire we saw the under 3% unemployment rate really putting pressure on the labor market or helping boost wages to get to that 2017, 2018, 2019 boost that got people back to about where they were in 2005 and 2006. Again, that's after a long period of economic recovery. And these wage boosts that we saw on the low end of the income spectrum, there's probably some interaction as well with another measure of household well-being, which is food insecurity. These data come in a little bit of a slower pace, and we have to look at 3-year averages to have enough data to know what's going on in New Hampshire. But here you can see the United States in green, New England in blue, and New Hampshire in orange. And this is, again, looking at that overall food insecurity rate. New Hampshire's is lower, which is great news. It's excellent that we have lower food insecurity than the United States as a whole. That being said, if you start to look at about 2011 and 2012, you see that the food insecurity rate in the United States as a whole started dropping in a steady fashion, again, as part of the economic recovery. But in New Hampshire, it didn't really start dropping in a way that we could say is statistically significant anyway, until you get to 2016 and beyond, and looking at those sort of 2016 and beyond data. And that corresponds with what we saw at the low end of the wage spectrum. So again, when we're talking about wages at the low end of the income spectrum, in the middle of the income spectrum, the sort of cascading effects in terms of households' well-being and ability to afford goods and services in the economy. Now, looking at a different data set that sort of shows the trends in another way. This is median household income, with that orange showing the inflation adjustment to the most recent dollars, the 2019 dollars. Median household income in New Hampshire, you can see that it was climbing prior to the Great Recession. So we get to 2007, there's that sort of earlier peak. And then there was a drop off. And it took until, again, we saw that sort of faster economic growth really after 2014 and into 2015 and 2016, where we saw median household income sort of bump back up and get back to those pre-recession levels, and even start to, in 2019, exceed them a little bit. But again, it's not, hasn't been a continuous path, and there was a period where a lot of people had less real purchasing power. Again, that probably slowed the economic recovery. Now, thinking about the industry makeup, thinking about where some of these jobs have been lost and where people have been earning income in New Hampshire, there are some large industries that have lower wages that are important employers in New Hampshire. And this is important when we're thinking about which industries are going to come back, which industries have been most affected, which industries are likely to help the economic recovery the most, or maybe lag behind the most. And here you can see in orange is, in the lighter orange is retail trade, and in the darker orange is accommodation and food services. Again, industries that have lower average weekly wages. And those are important industry sectors in the economy in New Hampshire. And these are, again, employment by in 2019. Healthcare and social assistance is the largest employer. For a long time, it had been retail, and healthcare and social assistance recently passed it. That healthcare and social assistance obviously includes a very wide range of wages depending on the job that someone is doing. There's some very high wages, obviously, and also some lower wages, again, depending on exactly what a person's role is or job is within that industry. So one thing I want to note, there was some discussion of savings and household savings in the last presentation, and it's great that in aggregate households have been saving more, but there is some variation. And one of the places where we see variation in terms of people's ability to pay for expenses going into this crisis, people's ability to weather this crisis, is if you look at data from just before the pandemic, it shows that a lot of households likely didn't have a lot of savings or didn't have a lot of ability to pay their regular expenses. So the US Federal Reserve System did conduct a survey. They conduct an annual survey, and they've conducted several recently. October 2019 was the one prior to the pandemic, and it found that 37% of US adults, so this is surveying the United States as a whole, so close to 4 in 10 adults indicated they would not pay for an unexpected $400 expense with cash, savings, or a credit card to be paid in full at the end of the month. So they likely had limited enough assets that they were going to pay for an unexpected $400 expense, which could be, you know, an alternator on a car that you need to get to work, for example, with something other than cash savings or a credit card that they would then be able to avoid going into debt with. So they might be selling an asset, they might be going into debt, they might be otherwise unable to pay it. Indeed, in that same survey in 2019, 15% of US adults indicated they wouldn't be able to pay their bills in full that month when they were asked. And if you add in that same survey an unexpected $400 expense, that would 16% of the people who said they could pay for their bills in October 2019 would then not be able to pay with an unexpected $400 expense. So a lot of people really close to the margin. And again, this is before the pandemic. Now, a similar survey in July of 2020 actually found that people were more likely to be able to use liquid cash for unexpected expenses. So that likely reflects those economic impact payments, those $1,200 checks, as well as those enhanced unemployment benefits. So again, providing support for the economy for people who were really close to the margin as it is, those are dollars that then get into the economy and really likely helped quite a bit during calendar year 2020, and hopefully will help again going forward. But when we think about usual household expenses, there are a couple different ways in terms of calculating costs of living. It's sometimes a challenging exercise, but there are two different calculators that are widely used. One is the Massachusetts Institute of Technology, has a living wage calculator. You can see their graph on the left, or their pie chart on the left is for New Hampshire as a whole. And the Economic Policy Institute Family Budget Calculator on the right is just for Merrimack County. They don't provide a statewide number. So I picked sort of a county that's closer to the middle, if you will. And you can see on the left, there's 2 working adults with 1 child. The total cost, the total expenses, or the total income needed to cover these expenses was about $58,000 based on MIT's calculations, with housing being the largest one. And the Economic Policy Institute, looking at a similar array of costs, they actually found transportation was a little bit larger than housing, but so these two models are looking a little bit differently at transportation costs, but housing was again a very significant one. And their total income was about just shy of $70,000 to meet their costs. So again, there's some differences in calculation, but these are numbers that are much higher than, for example, what many workers make over the course of a year in some of these low wage sectors. So questions for the economy going forward. And these are, I think, key questions that you'll have to think about when you're projecting state revenues based in part on economic activity over the next budget biennium. One key question that I have is, will workers be able to rejoin the workforce efficiently? And that could be, is there a job available in the field that they were working in before? Is there a job available in a different field that they are able to adapt to? Are they able to rejoin in the field they were in before? Is it safe, right? As the pandemic hopefully fades away over time and we get closer and closer to that herd immunity, are people able to rejoin the workforce? Are they safely able to rejoin the workforce? And if they can't rejoin the workforce in the same field that they were in before, are there sufficient training or educational opportunities that will enable them to engage in a post-pandemic economy? It's probably going to look somewhat different. We don't exactly know how, but are there opportunities for them to again sort of rejoin in a way that is productive for them and helps the economy overall? Will the employment losses that we see and the income losses that we see resulting from that lead to a more sort of regular recession over time? Right now, where you have this sort of uneven recession that has been affected by we have this sort of uneven recession that's been affected by sort of the disparate impacts in different parts of the economy. Will we see that some of the income losses, especially at the low and middle end of the income spectrum, have those been completely recovered for by both public sector activity, policy changes, and private sector finding other income from other places? Or will we see an economic slowdown? And you saw a little bit in the last presentation about that as well, which was a little bit optimistic on that front. And I don't mean optimistic in sort of, in my judgment, I mean that that's a positive sign.
Phil, would you question?
Yes, absolutely.
Representative Bromley. Pat, you'll have to unmute yourself.
Hey, thank you. Great presentation. So my concern is that, once herd immunity is reached and we're going to have a rush to open a lot of businesses, restaurants, hotels, theaters, entertainment centers, you name it. Even our ski areas have cut back. Not enough snow either, but that's another discussion. But I'm concerned that there's really not going to be, my real concern is there's not going to be enough workers to fill all those jobs, and that there'll be an upward pressure. There will indeed be a natural upward pressure on wages I think the lower level people are actually going to benefit from that. Wages will go up. But do you think that not enough workers are there to be an anchor to recovery, total recovery?
Yeah, so one of my so I agree. I think that is a concern, and I think those concerns are driven in part by long-term demographics in New Hampshire that that I don't think, to my knowledge, the fundamentals haven't changed as a result of this pandemic. We have seen more people moving to the state, so that might affect it some. But those long-term demographics are still exist and are still there. It's still part of the picture here in New Hampshire. So I think, again, I think that this is where having opportunities for people to enter the workforce, investing in people who might otherwise be marginally attached to the workforce, so that they, should they choose to, and should employers be able to find them, right, be sort of more full-fledged engagers, if you will, in the workforce. And there are a lot of folks who are who have been on the peripheries, and we saw during this economic recovery, the tail end of the economic recovery from the Great Recession, sort of more and more people coming into the labor force over time, more than many economists expected, frankly. So my hope would be that there would be a combination of sort of that effect of investing in people who are otherwise sort of marginally attached to the labor force, really getting them the training and opportunities that they might not otherwise have, and benefiting from their engagement in the labor force, as well as maybe some in-migration. My hope is that because this is sort of such a swift economic event, if we start to see this unemployment rate, the unemployment rate continue to track, or if we continue to see the unemployment rate contract and shrink in New Hampshire in particular at such a fast rate, that that a lot of institutions, right, both educational institutions and employers, will remember the sort of workforce constraints that we saw immediately prior to the pandemic in New Hampshire will be sort of fresh in everyone's minds, and there'll be more opportunities for coordination, retraining, and efforts to make it so that people who are either marginally attached to the labor force or otherwise have not received the educational investments, have not received the training opportunities that they have in the past, that there will be more of those opportunities, there will be more of those investments, and that will get more people into the labor force to help address that concern, because I think it is a real one going forward.
Okay, we'll take 3 more questions and then you can continue from. Next is Senator Rosenwald.
Thank you, Mr. Chairman. Phil, through the middle of October, New Hampshire has received about $85 million in additional federal Medicaid funds. That's 6.2% extra FMAP. Do you have any estimate of what we might expect to receive through the end of the biennium?
Unfortunately, Senator Rosenwald, it's a great question, and one of the key ways in which the federal government has provided support to New Hampshire's budget, certainly thus far. I don't have an estimate for through the end of the biennium. My understanding of that additional FMAP increase, that enhanced Medicaid match, is it is dependent on the federal public health emergency. So I don't know how long that's going to last, but whichever, as long as some part of the quarter is covered by the federal public health emergency, then that enhanced FMAP applies to that, to those quarterly payments that are made through the federal Medicaid program. But unfortunately, I don't have a number to estimate that.
Senator Hennessy.
Thank you, Mr. Chair. Phil, thank you for taking my question. My question, I believe it was on page 4. You had a very interesting graph that showed the low wage, the middle wage, and the high wage. Have you ever looked at this with an overlay of the jobs that are available in these 3 different categories and the changes in them? Because the reason I ask is that, I mean, just from employers contacting me, but also just reading any newspaper, I see a lot of jobs available. Is it, and I just would like to get your opinion on that and see if you've done that before.
Right. So there may be some interaction between what we're seeing here in terms of employment changes and what we're seeing in changes in the civilian labor force. Right. So I think that part of this mismatch that we see, or part of this mismatch between, some jobs are available and there don't appear to be workers available for them. And there are some workers who would prefer to be earning income in the economy and aren't able to find work, or seeing that, the low wage job sectors obviously are a ways down. I think some of that mismatch is why it's really important to have sort of an intentional process of being able to take folks who either have received less investment in terms of training, in terms of education, and connecting them to job opportunities. I think, because I agree, I think that there is some of that, and there was some of that prior to the, in the aftermath of the Great Recession as well. There was some employment mismatch, and there's questions around how much of that is cyclical and how much of that is structural, and it's something that's actually been a fair bit of research around in the recovery from the Great Recession. It's hard to say because this economic shock is so different, exactly what that's going to look like in the recovery here. And because it's such a shorter time horizon, or potentially, hopefully, a shorter time horizon than the Great Recession. But I think that you do raise a key question around why are we seeing these sort of different experiences. And I think that once the sort of natural disaster portion of this recession, right, the pandemic of this recession subsides, then we'll see a little bit more about how that shakes out. I think it's a hard question to answer at this point. So I'm sorry, that those are the best thoughts I have for you at this point, Senator Hennessy.
Thank you.
Yep.
Okay, and then there'll be Representative Tucker followed by Senator Geider, and then we'll hold the questions until Phil finishes, because he has 17 more slides to do after that. So Representative Tucker.
Thank you, Mr. Chairman. Thank you for being with us today. I didn't see in your comments or your slides the apparent differences in how this crisis has affected women and how it's affected men, and the role of childcare, preschool, and generally education plays into that. And perhaps you have slides later about that, but I think that's something that's really quite different than prior recessions or the Great Recession. And I wondered if you could comment on that.
Sure, yeah, and it is absolutely different than what we saw during the Great Recession. During the Great Recession, the majority of people who were applying for unemployment assistance in New Hampshire were men. And in the first 3 months of the pandemic, if you will, or the second quarter of calendar year 2020, the New Hampshire Employment Security reported that about 59% of the people applying for unemployment compensation were women. And so that's a pretty massive shift. This is, again, a recession that is more focused on the service sectors in the economy. Some of the, some of the sectors that more traditionally employ women or tend to employ higher percentages of women rather than men. And we've seen that nationally, there's been some research around who is dropping out of the labor force. So again, that's back to this, the blue line here, showing why are people not in the labor force. And we've seen some research that suggests that not only women, but women with children are more likely to have dropped out of the labor force than not only men, but women without children as well. So that suggests there's definitely a child care component here. There's definitely a component where, as it's safe to reopen schools, will we see more people rejoin the labor force? Will we see more women with children able to rejoin the labor force? So that's sort of the upshot when it comes to how some of these metrics might move and what it might do for the economy. That being said, there's a lot of people, a lot of women with children, in particular, based on the statistics we've seen, who dropped out of the labor force, who weren't able to engage in employment. That has ramifications for their careers in the long term, and their earning potential, and their ability to engage in the economy in the long term as well. And I think that that's an important consideration going forward, especially when we look at the economy for the next years in the future.
Senator Geider.
Thank you, Mr. Chairman. Phil, good presentation as always. If you go back to that slide that you pulled up initially for Senator Hennessy, that
sure,
showed
absolutely.
my question is Of those three brackets, do you have any numerical or percentage of the workforce numbers for those brackets, particularly those that did not participate in the economic prosperity, that lower
Yeah.
bracket?
Yeah, so
In New
in
Hampshire, yeah.
So for these numbers for New Hampshire, I don't have those, but I can see if I can find those in this research for you, Senator Gaida, and send those along as well. But we do see, so we know what the incomes are, and these are incomes based on what these jobs paid in 2019. The incomes are for the high wage are greater than 60,000, 27,000 to 60,000 in the middle, and then low wage is less than $27,000. So again, median household income in New Hampshire, we know in 2019 was about 75,000, but that's a household that's again roughly 2.5 people. So the median, in terms of the median wage and jobs, I would want to go back and match up those numbers with you, as opposed to match up those numbers and provide them to you, as opposed to trying to remember them off the top of my head. But I can provide those to both committees.
All right, just by way of quick commentary, Mr. Chairman,
Yeah.
The women with children component that is not recovering, I think, is largely due to the school issue, where we have many of our schools going hybrid or remote completely intermittently, and the child care issue is a huge one. Thank you.
Okay. Well, I'll let you continue, Phil.
Right, absolutely. So some more questions for the economy going forward, and we actually already covered a fair number of these questions. I do think additional federal action will be a key consideration. And how does that affect the economy overall? How does it affect the ability of residents to make ends meet themselves? Obviously, there's an interaction there with the broader economy. What role will the state play in supporting the economic recovery? There are a lot of state services that are provided that are pretty key for people to be able to not only invest in their education and training, but also make sure that they stay in their homes and have resources going forward. What happens to the international economy and what happens to trade as a result of that? Even as we advance towards herd immunity, hopefully over the course of this year in New Hampshire and in the United States, what happens in terms of international trade impacts and international economic interactions and other forms that affects what the economy looks like going forward for over many years? We may not get to herd immunity in a lot of places, if you will, for many years to come. It really depends on the vaccine rollout, the vaccine availability, the investments made in countries that don't have the resources to invest in themselves in the same way in terms of buying vaccines for large swaths of their population. So I think that's a question going forward. Also, what happens in the post-pandemic economy to commercial property values? What happens to how businesses organize themselves geographically? What happens to tourism? There may be less international tourism. That might actually help New Hampshire if more people are engaging in tourism locally. We did see some of that during 2020. And so there are many other areas where I think there are questions like this. So I want to shift to talking a little bit about state revenues. Understanding that you're going to be looking to project state revenues into the next budget biennium, I want to look back a little bit and note that we've had dramatic improvements in these forecasts, especially since the last time I was presenting to members of the House Ways and Means Committee. These are the forecasts for state fiscal year 2021 over several different iterations. We can see that in May and June, both the state agencies and the House Ways and Means Committee had estimates for 2021 of a maybe low 200 to high $300 million shortfall in the general and education trust funds. Obviously a very significant number. In July and September, the state agencies sort of folded back those forecasts a little bit to around $240 million. And in November, they presented to all of you some of the updated forecasts, which total between a $4 million and a $76 million shortfall in the general and education trust funds. Obviously a much more manageable number. And we've seen that these forecasts, as they've changed over time, reflect our understanding of the sort of economic crisis that we're in. Again, the modeling based on employment early in 2020 was suggesting some very significant shortfalls, but we've seen this recession behave quite differently. And we see that in the actual revenues as well. So these are the actual revenues on a cash basis to the general and education trust funds for each month of calendar year 2020. You can see state fiscal year 2020 is on the left side and state fiscal year 2021 on the right. And you see that dip, that drop associated with the initial impacts of the pandemic. We saw very significant revenue losses in some of those months relative to the state budget plan, which is that zero line. But we've seen since then, and thus far in state fiscal year 2021, revenues not only doing better than was expected based on what we were seeing in the pandemic, but also better than was expected in the state budget plan and the revenue estimates that were put together in September of 2019, well before the pandemic. So it's really actually remarkable. And if we look at a little bit more historical context for general and education trust fund revenues overall, this graph shows the 3-month rolling averages relative to the prior year and the percent changes there. And we can see that some of that faster economic growth helped in 2014 and 2015 and really started showing up in the revenues in 2015 and 2016. We see the next sort of rise that you see that's labeled there is the result of the December 2017 Tax Cuts and Jobs Act. A lot of companies were repatriating, a lot of multinational companies were repatriating dollars from overseas. Those dollars, some of those were captured by the business profits tax base. Those were expected to be one-time funds. So we expected to see a drop off after that. We obviously saw a relatively precipitous drop. Again, you can see the bottom spike on there is the nadir, if you will, of the whole graph is what's happened in the first half of calendar year 2020. However, in the second half and into state fiscal year 2021, we've seen revenues not only rebound from that, but also, again, be higher than they were the year before, higher than revenues in the second half of 2020 being higher than they were in the second half of 2019, again, talking about calendar years there. So it's really substantial. And why might this be? What are some of the things that have contributed to this? That might, talking about that might help inform what we see going forward. So here, the revenue source that has taken the largest hit and is the second largest tax revenue source the state actually collects is the meals and rentals tax. The meals and rentals tax obviously was impacted in April and May. You can see those actual numbers in orange. In May, the projections produced by the state agencies on looking at a monthly basis, you can see that the Department of Revenue Administration expected it to dip a little bit more than it actually did in the summer. There was a fair bit of innovation, and a lot of businesses were, especially restaurants, which are 80% of the tax base here, were innovating and finding ways to get consumers in the doors. You can see the next set of projections in November, which are borne out thus far in the December data, don't suggest this will continue to add to the budget deficit as opposed to the surplus relative to what was in the state budget plan. Again, that $0 line. Cigarette sales have been much higher than expected, and that's something that we see, again, higher than even the state revenue plan. That's something that's expected to continue going forward through the rest of this fiscal year, again, from the Department of Revenue Administration. That is driven maybe in part by people smoking more, if there's greater stressors out there, which there are, in part by cross-border sales because of policy changes in Massachusetts that I believe DRA spoke about yesterday. And some of that may be people stocking up as well, not knowing what's going to happen in the next month or two related to the pandemic. Real estate sales, and I know you're going to hear from Ben Frost later today, real estate sales have rebounded in a way that was not expected. Usually this moves with the economy more generally. Again, we're seeing these uneven economic impacts. So the actual is quite a bit higher than what was planned and what was projected earlier in the year. And the question in my mind around this, the real key question is what happens with inventory. Both sales volume and sales values are up for single family homes relative to the prior year, which was already a hot market and with little inventory. So what happens with inventory going forward was, I think, be really important here. New Hampshire's interest and dividends tax also has seen has been generating revenue sort of above expectations, suggesting that for folks who have significant assets and who are paying interest and dividends tax to New Hampshire, we're seeing that those assets are are generating revenue not that far off from plan in recent months. And again, there was a filing deadline shift, so that's why we see a little bit of that seesawing, if you will. But those are still holding up in a way that you might not expect in sort of a regular recession. And then business taxes have been the primary driver of what we see as the revenue surplus so far this fiscal year. And the Department of Revenue Administration, again, these are performing better than expected, better than we would see in a regular recession. The Department of Revenue Administration has noted that there are some businesses that are doing well and some businesses that are doing poorly. Again, it's a really sort of uneven and not typical recession, but also that large businesses are doing relatively well and are doing better than was expected. And we heard a little bit in the last presentation about corporate profits as well. And those large businesses are an important part of the picture. So this table is derived from data produced by the Department of Revenue Administration. This is the business profits tax base for tax year 2018, looking at the different size businesses in terms of their taxable profits under the New Hampshire business profits tax. You can see that over on that left-hand column. Tax year 2018 is the most recent year we have these data for. So you can see the cumulative percentage that has taxable business profits of at least that number on the left-hand column. In that middle column, you can see that cumulative percentage of filers, and you can see the cumulative percentage of revenue paid on the right. So if we look just at the top line, you'll see that for businesses that had taxable profits attributable to New Hampshire after apportionment of at least $12.6 million, that was actually, it was 76 businesses, is that 0.1% of filers. And those businesses paid close to half of the total business profits tax that was collected. So the reason I'm showing you this table is to emphasize how important those large businesses are for understanding what is happening with business profits tax revenue. Another way to emphasize that is if we look at the filers by type, like by type of business. Proprietors, which could include, sole proprietors and so self-employed individuals, make up the largest share of filer types. And you can see corporations and partnerships are also significant as well. That orange slice are water's edge filers, so a type of combined reporting that generally reflects multi-state and multinational businesses. They made up about 6% of filers, but keeping the colors the same in terms of the revenue that was paid, they made up 62% of all the revenue. So again, what are typically large multi-state, multinational businesses are a really important part of the tax base. Now, I'll note this was tax year 2018, so these numbers are their most recent numbers. They're probably a little bit higher because of some of that repatriation. But even if you look at tax year 2017, it was about 57% or 57 or 58%. So again, the largest businesses are a key part of the business profits tax base. The business enterprise tax base is a little bit more distributed. So you can see to get to about half of the revenue collected through that, you have to get to the top 0.8% of businesses in terms of their business enterprise tax base, as opposed to the top 0.1%. So that gives you a little bit of a sense of how the business enterprise tax interacts a little differently. And the interest and dividends tax is also one where we see that the top income earners are really important to understanding what's going to happen with interest and dividends tax revenues. So for example, people earning filers, I should say, people or joint filers generally, who are earning $200,000 or more in just interest and dividend income, so this is interest and dividend income alone, paid about half of the interest and dividends tax. Again, a little under half in tax year 2018. But while we're talking about these important state taxes, however, and they are pretty key to state finances, it's important to remember that of state and local taxes collected, the property tax collected and expended at the local level dwarfs a lot of these individual state taxes. So you can see the 5 largest state tax revenue sources in state fiscal year 2020, not counting the statewide education property tax, because that's raised and retained locally. So that's added on to that local property tax levy. Again, much more significant than even our largest state level tax, the business profits tax. So I think questions for the future relative to revenues in the economy: will a more sort of regular recession happen, and will it lead to a general slowdown in revenues as opposed to the sort of disparate impact that we've seen? This disparate impact, different in different sectors, has meant that sectors that happen to match some key state revenue sources for New Hampshire, like large corporations have actually been performing well. Will they continue to perform well? And it could be that they very well may. That's just a question of how does what's happened in the economy and in different sectors of the economy interact with our tax bases in New Hampshire. The slower wage growth has happened during the last recession limit state revenues. It could be that we don't see that slower wage growth. It could be that we do. That's something that I think is important to watch for and consider. Are there long-term international trade impacts that affect business profits tax revenues in particular? I think that's a key question. Do restaurants recover? And in particular, do they recover in commercial areas? I'm thinking of some of our downtowns in New Hampshire. That could be that there is not the same sort of recovery there in terms of people going out to lunch, whatever it may be. And then what happens to both residential and commercial property values? We may see them go in different directions. Commercial property values, I think, are a big question mark going forward. And what are the implications for pressure on local property tax revenues? So some key takeaways. The COVID-19 crisis had a swift and massive impact. It had the most severe effects on those with the fewest resources. There are pretty stark differences relative to what we would see in a regular recession. There's not this general slowdown. It's a little bit more varied. And federal assistance played a really important impact in the 2020 economy being as good as it was, given the conditions and given some of the other indicators that we see. And that's true in New Hampshire too. Pardon me. And tax revenues from businesses, tobacco products, and real estates have done surprisingly well, but the uneven impacts of the crisis have been clear in those revenue streams. And larger businesses, higher income earners, and property markets and values are going to be important for key state and particularly that last one, local revenue sources as well. I think there is some risk that this uneven slow wage growth and uneven industry impacts hinder a robust, equitable, and sustainable recovery. And that may be a way that we don't see in the top line numbers as well. Like the top line numbers may mask some of that unevenness in the recovery. So I'm happy to take any questions. I know I only have a couple minutes left, but I appreciate the questions partway through. And I know this is a lot of material. I'm happy to talk you through any bit of it that you'd like.
Okay, question from Representative Alamy.
Thank you, Mr. Chairman. Phil, we've just gone to market-based sourcing in the business profits tax and the business enterprise tax. And we are about to go next year to single sales factor, which I think could have a much larger impact. Have you looked at all at what the Water's Edge and the other large corporations do in terms of their sales to the exterior of the state, which is what single sales factor would not tax?
Yeah, and I think that's an excellent question and an excellent point. I think that single sales factor does introduce the prospect of perhaps more volatility with changes in the economy. I haven't been able to look and see what the, especially the Water's Edge reporters have in terms of the breakdown of single sales factor versus the three factors. So I think that's an excellent question. I imagine that DRA would be able to dig into those numbers much more deeply than I can based on the information that they have available. But I think that's a key consideration. I'm sorry, I don't have a more complete answer for you on that front.
Yeah, neither do we.
Representative Bromley. Patrick, you're gonna have to unmute yourself.
Did it again. Thanks, Phil. There seems to be a lot of wealth moving into New Hampshire, given the increases in the rent, and we know that it's really putting an upward pressure on the housing prices. So do you think there's a correlation there with what may happen with interest and dividends, because those wealthy people will have investments that will be taxed? Or do you think that's even will move the needle at all?
It could very well move the needle. If we look at the migration data and find that we're talking about many more thousands of people moving to New Hampshire, and if you were to make some assumption about how many of those people are really high wealth individuals that again drive that interest and dividends tax base, it could move the needle on that front. Again, remember there were only about, I think in the table it was about 66,000 filers for the interest and dividends tax. So several thousand could change things. However, I think it would be hard to forecast that. I think things like the stock market more generally are going to add more variability probably than that. But that's just a hunch. So I think it's good that you're thinking about it, but I don't know that it will move the needle that much, or at least in a way that's that forecastable.
Okay, thank you.
Yep, you're welcome.
It looks like we're right on time here. And, we have time for one more question, but I do not see a hand. So Phil, thank you again for an excellent presentation. And we expect to hear more from you in the near future.
All right, thank you very much, Chairman Major. I look forward to the opportunity to speak. Thanks everyone for your time this morning.
Okay, we are right on time for our next presentation, which is going to be by Dave Gervais, who's the Senior Vice President of Policy for the New Hampshire Business and Industry Association. And Dave will be discussing the state's housing market and housing challenges. And I believe, Dave, you have some representation from a couple of the businesses with you. So Dave, it's yours. Jen?
Mr. Gervais is on the call. He just needs to unmute.
As I've now demonstrated to
Yes,
the
we can see
legislature,
that.
I'm technology challenged. Thank you, Mr. Chair and members of the House and Senate Ways and Means Committee. We were very happy to be invited to participate. And I thought the best way to provide sort of a photograph of what's going on with New Hampshire's economy, especially in the manufacturing sector, was to invite 3 BIA members, and they're from very different types of companies. So let me quickly introduce them, and then we'll move into their presentations and then be happy to address any questions that committee members will have. First, I'd like to introduce Tom White. He's president of New England Wire Technologies. New England Wire Technologies is in Lisbon, New Hampshire. It's a privately held employee stock ownership company with more than 400 employees and facilities consisting of over 385,000 square feet of manufacturing, quality testing, tooling, machine fabrication, and office space. Their on-site manufacturing processes include wire drawing, plating, braiding, cabling, insulating, and extrusion services. And I'm sure Tom will provide a little bit more detail as a part of his presentation. Next, we have Val Zanchuk. Val is president of GraphicCast Inc. GraphicCast was founded in Jaffrey, New Hampshire in 1978 and currently has 21 employees. So we've gone from the spectrum of a large manufacturer down to a rather small one. The company provides contract casting and machining manufacturing services to over 70 industrial customers and offers a portfolio of 170 different unique parts. And finally, we have with us Cheryl Lawson. Cheryl is the COO and CFO for the Lawson Group. Lawson Group is a family-owned business. They've been around for over 40 years and are based in Concord, New Hampshire. They employ more than 40 people and specialize in health and safety consulting, providing employee wellness services, and serving as third-party administrators for workers' compensation programs, including a manufacturer's program with almost 200 manufacturing company members. So I thought she would be extremely useful in talking about the experiences of many of her manufacturing trust members. But let me first turn to Tom White, president of New England Wire Technologies. And Tom, let me turn it over to you.
Good morning, everybody. Can you hear me?
Good morning.
Yes. Again, my name is Tom White, president of New England Wire Technologies. Dave did a very good rundown of who we are and what we are. We're the main manufacturer in Lisbon area. And we are a type of company that I would call is non-commodity. We make specific wires for special needs, and the strength of our company are our employees, period. We've got a great work ethic. We have, like I said, about 400 employees. And I will say that 2020 was a challenge. Timing is everything in business. And we decided to earlier to engage in a brand new ERP system. That was started on January 1st of 2020. And then, of course, in February, we were challenged with the COVID situation. So we were challenged with two major difficulties for the company in 2020. In 2019, we had a goal of sales of approximately $80 million. At the end of 2019, we had sales of $82.9 million, which is about a 3 to 3.4% increase in sales that are projected. Because we had some certain scenarios during that year, we projected for 2020 of an $82.5 million worth of sales. And in the first 4 months of 2020, it looked like we were going to achieve up to potentially 7 to 8% increase over that projection, and then COVID hit. We ended up the year with approximately $73 million worth of sales, and which was a 11.5% reduction in our sales. And again, I would say, looking back at it, I think our achievement was the greatest achievement in the history of the company, or at least in the 40 years that I've been an employee at New England Wire. Our staff was engaged. The effort was tremendous. It was a next man up or next person up, however you want to look at it. And I can't be proud of our employees and what they were. We had a situation where the number of orders were typically equal, but instead of getting a $50,000 order, we might have gotten a $5,000 order. We were fortunate enough to be identified as an essential company, and we certainly are essential because we meet many demands in the medical, the defense, and certainly in the power industry. We were fortunate enough, even with the sales level we got, if we hadn't got about a $2.5 million worth of orders in the medical area for ventilators. The ventilators was huge for us, and we turned our facility around for ventilator cable. Again, very proud of our people, what we did, what we accomplished. The disconcerting thing to me was it was great, but every inch of wire we sent to China, which was disconcerting to me, to be honest with you, because I really had hoped that it would have been all made in the U.S. But again, we did it. We did a great job. Now, for 2021, we're looking at $79.1 million in sales this year, which is about a 8% increase over our actual sales last year. Our challenges we still have challenges, even though the unemployment rate is what it is. And I'm not a believer in that rate, to be honest with you. We still have challenges finding people to work. And again, our compensation rates are equal or better than any employee in the area. We have an ESOP program. We have a profit sharing program. Last year, we shared about 56 hours of bonus with our employees. And I look at us as being a very positive employer. And I'm positive about the direction of the company. I'm positive about the direction of the economy. I'm not a politician. I'm one who believes that we're all in this together. And I wish that both sides would look at it in the best interest of the people, not necessarily in the best interest of a political party. And I think you people will. And I know we'll survive this thing. And in the long run, I communicate to our employees very simply that we'll be better. When you get challenged, you come up with strategies that make you a better company. And I tell you, I can't be, like I said before, I'm reiterating again, how much pride I have in our employees and how they've overcome things. We at one point had approximately 50 people out of our facility based on the 5 or 6 qualifications of being able to leave the company, whether because they had children who were out of school, whatever it may be. And I tell you, people stepped up. Our whole manufacturing force stayed in the facility. We followed all the CDC guidelines. We bought equipment for sterilization. We did the mask. We did send our sales group out of the office for the fact that we thought they could, and they did work fine in remote. I'm one that wanted our people to work here because I think you can develop a team when you talk to people face to face. And we lost some teamwork with people being out, whatever, but we did hold it together. We are presently now, everyone is back in the facility. And I'm very positive for the future. And I may be the president of New England Wire. I'm probably best at being a cheerleader for New England Wire because in the positions today, you need to be positive. You need to be show people there's a way to improve. There's a way we are going to get through this. And I feel strongly we are. So
thank you, Tom. Mr. Chair, do you want me to pause for questions or do you want me to go into the next panelist?
Why don't we do the 3 panelists and then we'll come back to questions.
Fine. Our next panelist is Val Zanchuk, the president of Graphic Cast, a manufacturer in Jaffrey in the Monadnock region. And Val is apparently broadcasting from the rather palatial offices that come with being the president of that company. And he has a presentation. He'll be sharing his screen. So Val, let me turn it over to you.
Yeah, I wish that were my office. Yeah, as Dave mentioned, we've been in the Jaffrey area since 1978 with 21 employees. We were up to about 25 or 21 right now, trying to balance things out. As Dave mentioned, we are a contract manufacturer, so we make things for other people. We have no products that are branded under our name, so we have to be pretty agile and pretty flexible in our ability to respond to the needs of those customers. And as Dave mentioned, we have a portfolio of about 170 different parts that we make for those customers, but we really have no control over when they're going to order from us. So we're operating basically at the will of not only those companies, but also sort of at the direction and influence of the national economy. And the other thing we contend with is that there's a difference in time between when we get an order for something and when we actually produce it, just because of how things line up in our queue. So typically right now we're running on a 16 to 18 week difference between when an order is placed to actually when we produce the part and ship it to the customer. So as you'll see in the graphs that I'll show you, those lags are represented by the types of volatility and fluctuation that we have. The other issue that we have, I call it the Goldilocks syndrome, is because we don't have control over the business coming in and we don't know when it's going to hit and whatever, we're trying to be able to balance our employment level and the inventory of equipment we have on the floor so that on average, we can meet that demand. Sometimes the demand drops off and we have too many people. Sometimes the demand picks up and, we can't put enough hours in a week to keep up with it. So that's, how we have to try to juggle things. And I did mention, if you run a business like this, you definitely need a very strong stomach. Some people lose sleep, I don't, but it has its ups and downs. So just to give you some sense of the impact, if we look at the bookings, these are the orders that we actually get. Going all the way back to 2007, you can see the impact of the recession and some of the other things that took place nationally and globally on our business. 2007 was actually the best year we ever had with the company. After the Great Recession, and you can see the impact that had on our business in terms of bookings, we dropped about a third to 40%. Many of our customers did not come back. They just disappeared. So between then and 2012 or so, we rebuilt the business. Then there was a small slowdown in 2012 that affected us then. We went along fairly well until about April of 2015. There was a global manufacturing recession, was very, very abrupt. And it took us about 4 years, as you can see here, to get out of that recession and actually build ourselves back up to a range that we were operating profitably and fairly steadily. And then COVID hit. So we're down quite a bit. Bookings, 25% down, calendar 2020 compared to 2019. And if we look at that in a little more detail, the last 2 years on a monthly basis, you can see that through 2019 into the early parts of 2020, there was a lot of volatility in terms of bookings. We'd have some months where we'd get almost $500,000 in orders, and then the next month we'd be down to $100,000. So very, very volatile. For us, the COVID impact really started around July. During the first few months of the COVID impact, April, May, June timeframe, we were quite busy. We have one customer who makes diagnostic equipment for measuring COVID in samples. Their business was booming. We couldn't make parts fast enough for them. But once July hit, the momentum that we had built up through the first part of the year fell off dramatically. And as I show here in August of 2020, we almost had no orders at all, which is the only time that's happened in 42 years of company history. So you go from August of 2019, $384,000 in new orders, to August of 2020, and it was almost zero. That's the impact that COVID has had on us. It's very, very dramatic. If we look at our shipments, and again, over the same time period, this is a monthly shipment schedule, you can see the impact of the recession as we dropped through 2007, 8, and 9. We picked up to 2012, dropped off a little in the summer there, built the business back up to 2015, went through a long recession of very, very flat sales for 4 years. And then just as we were coming out of that recession, COVID hit, and we've dropped off again. And if we look again at a monthly impact, you can see what happened there. Monthly shipments were, again, volatile, but a little bit more steady than the bookings. But then in July, the June and July timeframe, our shipments dropped by 50%. And in the third quarter, July, August, and September, we were down 41% compared to the same quarter of last year. Year to year, we're down 12, but that particular quarter was bad. But as you can see from July through the end of the year, a slight improvement, but not nearly enough to make us profitable. So we're running right now, we're running just about break even. So we're really seeing the impact of COVID on us. We really have a hard time projecting forward because we really don't know what's going to happen to our customers. Some of them have come back reasonably well. Others are still struggling. Long-range planning for us is probably about a month. If I tried to project out a year, I don't think I would be able to get even close to what may happen. I know from our backlog that this quarter, the first quarter of 2021, looks pretty good. It's a continuation upward of that trend, but it's nowhere near where we had to be. And we suspect by the end of our fiscal year, which is June 30th, we'll probably be down 15 to 20% compared to the prior fiscal year. So it'll be another year probably of a loss on the bottom line. And it'll still take us a little while to climb back out of this. So very frustrating in that we were on the verge of really breaking out of a recession. Now we've been hit with this, and there's really no certainty. And I think that's the biggest issue we have right now. It's very, very difficult for us to predict with any degree of certainty exactly how things are going to go, in the next year. I can tell you in the next 3 months, things look pretty good, but beyond that, it's relatively flat, and we really don't have that much visibility. So it's going to be a tough year for us. We haven't, cut back on salaries. We've managed to squeeze out some investment and some new equipment, but it's a real juggling act trying to balance everything out. So we're, as previously mentioned, we're optimistic about our business and its capabilities, and we're trying to operate within the boundaries of the uncertainty that we have right now with the virus. So we suspect this year is going to be relatively flat for us. We don't see a lot of growth opportunities. If anything, just a very slow recovery out of the depths of the pandemic. So that's about it. Thank you.
Thank you, Val. And now let me turn to Cheryl Coletti Lawson. Cheryl is the Chief Operating Officer and Chief Financial Officer for the Lawson Group. They are not a manufacturer, but they have a lot of manufacturing members in their workers' comp trust, and they also provide services to a number of other non-manufacturing companies. I thought she would be good to wrap up our panel, just taking a look at from the 30,000-foot view what she's hearing from her clients. So Cheryl, let me turn it over to you.
Thank you, David. Good morning. Thank you for the invitation to address the committee. As David had said, we are the Lawson Group. 80% of what we do is we are a third-party administrator for 3 of the state's self-insured workers' compensation trusts. The largest trust being manufacturing, where we handle workers' compensation for today 215 worker manufacturing companies. Some, ranging from all sizes, large companies, small companies. We also handle workers' compensation for about 100 lumber-related industries, to mechanized loggers, cabinet makers, all things wood. And then there is another trust that we manage, which is Healthcare and Human Services, and that trust has about 72 members. All in total, we manage about $20 million of premium in the state. The other side of our business, which is 20% of what we do, is employer workers' health and safety. And we've been doing that for about 40 years. Interestingly, in our line of business in the non-comp, so just to touch on our own business of health and safety, this past year, we saw a 50% reduction in our revenue, 50%, which was really staggering. Folks weren't opening their businesses. It was all COVID related, and there was, someone explained to me in a presentation I watched earlier in the year about this so-called recession. Is it a supply recession? Is it a demand recession? And if it's a demand recession, it's harder to come out of. And they really believe that COVID is a supply recession, right? We just don't have access to do what we want to do or go where we want to go because of COVID. And as soon as all things COVID are improving, whether it's vaccines, testing, what have you, the demand goes back up immediately, right? So we're hoping it's an improved, it's a quicker return to normal. On our workers' compensation side, I will tell you that we won't see the impact of the pandemic in 2020 until we complete all payroll audits, because that's how our business model runs. And we're starting to get into payroll audits in Q1 and Q2 for all of last year. I can tell you that of all the members, almost 400 companies, no one shut their doors. No one called us up and said, I'm having such a drastic reduction in workforce that I need to revise my workers' compensation estimates. Right? And we firmly believe that that was because of the stimulus PPP money that was in the Main Street money that was available to all businesses. Right? We don't know what it will look like come 2021 year, but we honestly believe that the PPP money kept people going. We talk to all of our businesses constantly to understand how they're doing, what they're seeing in the current conditions. And I will tell you that our manufacturing group is our largest group, and there's a variety of people. There's residential business building products, OEMs, commercial building products. They run the gamut of manufacturers. And the common theme that we hear is predictability. Everybody wants predictability. If I say to Val, what's your perfect business model? He'd say, well, if I had no employees, if I had no equipment and no customers, life would be great, right? That's manufacturing humor. But we know that's not a fact, right? So all those three things, customers, equipment, and employees, create a level of predictability. But it's a predictability that we all as business owners can manage. If you throw the pandemic into the mix, there's virtually little to no predictability. And there are three things really that folks are struggling with. One is the supply chain, right? We have seen the vulnerability of our supply chain during this pandemic like no other time. You know, it is quite obvious that China is the world's factory. And given the fact that our manufacturers don't produce all of the parts necessary for their complete work processes, their work production times have slowed down. The delivery of product to customers, if their customers are still ordering, has slowed down. And we have no way to control that supply chain. And we don't know what that looks like in 2021 either. That's an issue out of our control. The second issue, and Tom touched on it as well, is employment. You know, employment has always been a struggle here in New Hampshire. You know, it's a blessing and a curse that we have the low unemployment rates that we have. And if you normalize for travel and tourism and hotel and restaurant, you know, our unemployment rates are almost back to pre-pandemic rates. Our employers struggled with the stimulus package with the additional enhanced unemployment benefit. People were able to stay home and make more money than going to work. They're concerned with what we're hearing that's coming out of Washington, that we'll be in the same place this coming year. Right? So we have a concern about the workforce and the ability to hire. Some of our employers are struggling with the availability of testing for COVID. Right? Can we make testing more available, maybe on site for employers, so they don't have that wait time, so they're not pulling coworkers to fill in at an overtime level while folks are waiting at home for test results that may be negative. All right? So is there a shift there that we can expedite testing? The other common thread that I see is revenue. Right? It's the inability to predict your revenue. Right? We have customers trust members whose customers are municipalities who aren't spending. We have members whose customer base are higher education who are not spending. There's a contraction in the sales force. There are some businesses, albeit as we heard Phil say just before this, that are doing very well. Sure, it's the larger businesses, much larger businesses, who have access to more resources. But most of our businesses and most of the business here in New Hampshire are your smaller businesses, right? Who don't have those resources. And they're getting very creative, right? Folks who are putting more money towards capital improvements in their shop. How can I improve my line? Because I know I'm not going to be able to hire the necessary folks. How can I improve, my production? How can I improve with some capital that I'm able to, to secure? And they were able to last year, some companies, improve their balance sheet with capital because of PPP funding. It's not going to be there this year. So I can say in summary, it's what we're hearing is uncertainty and predictability, right? And now you throw in one more piece of what would be coming out of Washington for increased tax rates for businesses, a push on an increase in a minimum wage. Those are all disconcerting. And they have business owners just pausing. So that's what we're seeing from our businesses, and Val and Tom couldn't have said it any better. So I appreciate the opportunity to come forward and just share with you what I'm hearing and the conversations we're having. So thank you very much. Thanks, David.
Thank you, Cheryl and Tom and Val. And let me turn it over to you, Mr. Chair. We are happy to try and answer any questions the committees might have.
Thank you. And I thank Val, Cheryl, and Tom for their presentation. It really helps the committee to understand the depth of the issues that are caused by the pandemic and how they're become so exasperated with the uncertainty that exists today. So we'll start off with the first legislator to ask a question is Representative Tucker.
Yes, my question is directed to Mr. White. I visited your plant 2 or 3 times, and it's very, very impressive, and it's an enormous asset to the North Country. I'm wondering whether you're finding that young people really understand manufacturing and find the idea of working at a factory appealing, or whether there's a problem with attracting younger workers, and what we can do to help you with that, if anything.
I think that's a great question. From my back history, I'm a former teacher, and we in this company have reached out to the local communities to try to educate schools and their students of what potential positions are available in facilities like New England Wire, whether it be accounting or engineering or production or whatever it may be. And I, for one, feel that the greatest asset that we have is our young people. I remember when I was young, older people would say, I would never make it, your generation's not, work ethic isn't good enough and all that. And I prove, I guess most of us proved them wrong. And now you hear the same thing from people in our generation saying the same thing about younger generation. I don't see that. I see the young people coming out of schools in this area are very capable. And as long as they're educated, the potential is there. And we have hired a lot of young people that have worked out great. Their work ethic is good. The capabilities for computers are far superior to mine. And we have a tremendous amount of computerization in our company. And I, for one, feel very confident that young people today, particularly, will go into manufacturing and do a great job. So again, the challenge is for something like Lisbon, in New England Wire, is our model is very simple. We want to keep our best here. For a long period of time, some of our best students in the local area, whether it be Woodsville, Lisbon, Littleton, Profile, whatever, we're going to school at UNH or a BC or a WPI or RIT and never coming back. We have made a priority that we hire somewhere between 20 and 25 college students per summer to try them on. One, I call them try them on. We want to see what work ethic, what capability they might be to become a long-term employee at New England Wire. And it's worked out great. We hired 4 or 5 people, college students last year for that. So again, probably a long answer, but I'm all for young people. And we can attract people from the production level all the way up to an engineering level, as long as you communicate, you educate, and you provide them a path to success, make themselves successful.
Oh, thank you very much.
Okay, Senator Geider.
Thank you, Mr. Chairman, and thank you, gentlemen, all for your fine presentations. My questions are 2. First, specifically to our manufacturing person, Val, and to all of you, do you anticipate possible federal tax policy changes impacting your taxes in New Hampshire, your contributions to our tax base? That's the first question.
I don't see anything from federal level having much of an impact on us, on my size company. You know, I take advantage of the various tax credits and whatever that are there. I don't see anything on the horizon that would have a major impact on us. So everything that we do in terms of investment and trying to move our company forward is based on our markets, not so much on federal tax or other types of policies. Things like the minimum wage, that could be a problem, as Cheryl was saying. I mean, we pay a starting person with almost no experience $16 an hour. People coming in with experience, maybe 17 or 18. That's a $10 difference right now between minimum wage and what we pay. That's a lot of incentive to work here. if someone can make 15 bucks an hour flipping burgers, or, working in an environment where they really have to, put effort in and think about what they're doing for a $2 or $3 an hour difference, I'm going to lose employees real fast. I mean, there's no incentive for anyone to want to try to learn a trade when the differential between a base pay for a low value job like flipping a burger is going to pay almost what I can pay. And I'm not in a market where I have that kind of value in my product that I can raise my differential back to $5 or $10 an hour. I mean, I'm basically breaking even right now. Unless the whole country went up and I could raise my prices and not be affected by it, differential raises in minimum wage, could kill companies like mine. We just don't have, we're not making turbine blades that sell for thousands of dollars where I can afford an extra couple dollars an hour in labor. We just don't have that. We're right at the razor's edge right now. If I could pay people more, I would do so, but I have to balance out between what I can pay and what the company can afford to keep itself alive. So those are the sorts of things that we worry about.
Thank you. Second.
Does Cheryl or Tom want to respond to that?
From New England standpoint, our starting wages are anywhere between $18 and $20 per hour. So what the feds do has basically no impact. From a state level, we're very much involved with the R&D tax. Our company is based on specialty products that requires a lot of investment into R&D and doing things like that. So that may have an impact. But in general, I don't feel that whatever the federal government does is going to have a significant impact on New England Wire.
Cheryl? Cheryl, you're muted. You'll have to unmute yourself, Cheryl.
Sorry about that. I think Val said it perfectly about the concern with the minimum wage. I mean, only 1% of the workforce is at minimum wage here in New Hampshire, anyways. I have heard from some members that the potential increase in taxes that are coming out of Washington may have some employers look at holding off on capital expenditures from a cash perspective. But I don't think it will have any impact on any tax base here in New Hampshire. I don't think it will have any impact on, staffing here in New Hampshire, because the problem is we can't hire enough.
Senator.
One last comment from New England. We've actually done the opposite. This is one last comment. We've actually increased our expenditures in capital investment. Mm-hmm. We felt strongly that in times of downturn, it was time to invest. And so
we've done the same.
We've invested about $4.5 to $5 million worth of equipment this past year in 2020 to do exactly what you're talking about, Val, to try to improve capacity, improve efficiencies and whatever, which again, we at one point were about 430 employees, now we're about 400. We haven't laid anybody off. It's mostly through attrition and retirement, but we've actually will be able to, I think, produce $80 million worth of sales in less people because of that investment.
Okay. Senator Geiger, the second part of your question.
Thank you, Mr. Chairman. I know this is of interest to you as well. Do any of your businesses utilize any New Hampshire business tax credits? I heard R&D mentioned. If so, will you increase your use this year because of the COVID pandemic? Or will it remain the same or decrease?
So we've been using the R&D tax credit since its inception. We pretty much have R&D going on all the time. Again, as a contract manufacturer, every new piece of business that I get is an R&D project. We have to develop a process, do everything else. I don't see us increasing it because it's really driven by, the level of business we have. If we don't have a lot of new business, there's not as much, but what we're doing along with that effort to increase our equipment's capability with capital investments is we're spending a lot more time refining the processes that we have right now, trying to get time out of them to get our efficiencies up, because we don't see a lot of top line growth. We're not going to see our sales increase a lot. So the only way we're going to survive is to get the cost out of our business. So that means new equipment. I just replaced a 30-year-old piece of equipment with a brand new machine, and we're trying to add new machines as we can afford to do that. But at the same time, we're spending time on those improvements. All that becomes part of R&D. So the R&D tax credit for us is a critical part of our business. So we're really, concerned when we hear, talk about reducing or eliminating the R&D tax credit, because it's so critical to a business like mine to help us grow.
Tom,
From our standpoint, we will continue to use at the same level or potentially increase. Relative to what Cheryl was saying about the companies that she does, we have consciously vertically integrated our company to be less reliant on other people. It was kind of we took the opposite route of what most people were telling us to do in the late 1990s and early 2000s, and said, we're going to be our supplier for ourselves as much as we possibly can. And that's where the growth has come from, our number of people as well as our technologies, because if we continue to grow as a company, that R&D tax is absolutely imperative, because we're investing a significant amount of money to improve our capabilities in the materials we're making. And honestly, we have had zero problems getting product from our suppliers. We've been very fortunate. We've had zero problems. And we've also tried to make sure that we have at least 2 suppliers for every product we get, which we're not always successful there, but we tried. So that's where New England's experience.
Cheryl?
Right. Yeah, we as the Lawson Group personally don't utilize any tax credit advantages here within the company, and Val and Tom can speak to it better than I can, on behalf of our membership.
Okay, thank you. Okay, the next question is from Representative Bromley.
Thank you, Norm. Thank you, everyone, for your presentations. So I think the 2 companies that we heard from that are manufacturers, Tom and Val companies, typify New Hampshire kind of manufacturing, where it's really where no consumer product type companies, no brand names come out of our state, with a few exceptions, no Apple computer, no Ford Motor, etc. So first I want, maybe Dave can touch on this for the committee, that these 2 companies really typify the kind of, even the larger ones, larger manufacturers seem to fit in this category. But my question after that for Tom and for Val is how much of your sales are in state versus out of state? So Dave, you want to take it first, and then Val?
Yeah, I'll just respond to the part of your question about what type of manufacturing takes place here. And there are some manufacturers that manufacture products, consumer products that are made here. But for the most part, the vast majority of manufacturers are what we would call component manufacturers. They make things that are sent to other manufacturers around the country or around the world to use in their products. And while I'm, I guess, on that point, that's what makes the R&D tax credit so critical for the manufacturers in this state, is they're having to develop oftentimes these new components and these new parts. It's what Val does almost every day of his work at Graphic Cast. So I appreciate Senator Gaida asking about that, because it does illustrate a really important and well-used economic development incentive here in New Hampshire.
Talking about our customer base, I have about 70 companies that we make product for. Only one of them is in New Hampshire. Everyone else is some other state.
Thanks, Val. Tom?
About 5% of our sales is in New Hampshire.
you say 5?
About 5%. But the main supplier for one of our raw materials is also a New Hampshire company.
Thank you.
Okay, next is from Jordan, Representative Yurley.
Thank you for taking my question. The comment that was made, I believe it was by Mr. Zanchuk regarding the minimum wage. I thought that was telling, where if you have a set base for a McDonald's worker of $15 an hour, that means that for you to compete, you're going to have to, and you're doubling the minimum wage now, so you essentially would have to double your base rate, your entry rate wage, and that would mean then that you would have to raise your prices as well. And that, I think, would apply across the board to the entire manufacturing spectrum. That would be, your comment, Mr. Zanchuk, I thought was very cogent. The other part about that is, though, but if you're raising your cost and I'm buying it, that means that I have to raise my cost for the product that I'm manufacturing, which means the costs go up. So the effect of a minimum wage raise doesn't exist. Is that analysis basically correct from your point of view?
Yeah, it is from mine, because, you know, if everything went up, you know, 10%, you know, then relatively everything is still in the same proportion. I mean, in the end, you know, a job pays what it's worth, and the value that it produces for the company that's employing that person. You know, if the value isn't there, you can't pay them more money. It's not supportable economically. That's why I mentioned about, you know, the intrinsic value of the product that we sell. I mean, we have some parts that we sell here for $3 or $4 a piece. The most expensive part we sell is about $120. You know, we make a certain margin, you know, between what we pay our employees and the benefits and everything else that goes along with that. If at the end of the year, you know, we have 2% or 3% on the bottom line, that's a lot, you know, for a small company. So, you know, we become an engine to keep 21 people and their families, you know, fed and housed, and you know, we have a little left over. And as an ESOP company as well, you know, that helps our employees. But there's really not much there at the end of the day between what we have to do. If we were in a market where we had the ability to pay more right now, I'd be paying it, because you know, I'm in a competitive employment market here in the Monadnock region. I have New Hampshire Ball Bearings on one side of me with 800 employees. I have Millipore on the other side trying to hire 300 people. I mean, they're all within 3 miles of where I am. So I have to pay competitive wages and have competitive benefits just to try to get people in the door. So, you know, it's a real struggle trying to, you know, offer enough money to get people in and also being able to pay them. And it's driven by our sort of market wages for what we do here, plus the general economy. Any disruption to that is totally arbitrary and not reflective of economic value generated by people is just going to disrupt the balance there. So there has to be a reason and an economic value to increasing wages. I just can't go out and raise my prices 25 or 30% without having, you know, somebody in another part of the country outbid me, and I end up losing the business. And then what happens is 21 people are out of a job. So, I mean, it just doesn't make sense.
It's my opinion that by raising the federal minimum wage is going to negatively impact the market that is most affected by COVID. You're talking about restaurants, you're talking about hotels and hospitality and stuff like that. That's the labor markets that's been affected by most by COVID, as far as I can see. And when you raise the minimum wage to $15 an hour, you're going to put more and more companies or hotels or restaurants out of business. because of it. I'm a big believer in open market. You pay for what you can pay for. And if you're paying lower than somebody else, then you may not get an employee. But let the open market determine what the wages are. And that's just my opinion.
Cheryl?
I concur. They've said it. They've said it the best. Anything I would say would be completely redundant.
Okay, next question from Representative Almy.
Thank you. I'm not going to get into the minimum wage, but on the situation was the same back in 20 years ago, 30, 40 years ago, I guess it was. But our minimum wage hasn't changed. So, and the federal government and the state governments have to make up for that in the lower income groups. So it's a very difficult problem. I agree. But what I wanted to ask you about was there is a federal research and development tax credit, which when we put in the federal, the state tax credit, I was instrumental in that at a much lower level than it is now, was a great deal higher than the one coming from New Hampshire. What percentage of the total research and development tax credit that you get, which is critical to your development, what percentage of that is actually the New Hampshire tax credit?
Lisa, in our case, the New Hampshire credits, well, the amount that we get it has varied. When we first started taking the credit, we were getting somewhere on the order of like 15 or 17% of whatever we put in for a credit, because it had to be, it was limited by the $1 million or $2 million. Right now we're getting about 85 or 90% of what we put in, but the New Hampshire portion of the total R&D tax credit that we get, federal plus New Hampshire, I think New Hampshire, and I have to look at the numbers, but it's probably like a 25% or so. I mean, it's the federal impact is, there's no limit to it. And at the New Hampshire level, based on the number of companies that have put in, we're relatively close to being able to, offer a credit equal to the amount that's been asked for. I know there's some restrictions on the actual amount, and we've certainly seen it over the years as we've gone from 1 million to 2 million to $7 million credit. We've gotten closer to 100% of what we have put in for. And applying for the New Hampshire credit is fairly straightforward because it uses the federal form. So if you're going to apply for the federal R&D tax credit, the time it takes you to add the New Hampshire credit on top of that is minimal. So it is a very simple system to use, but it doesn't, quite have as much of an impact as the federal credit does.
Tom?
Yes, and I don't have the numbers, but I can certainly get those for you. But and if you'd like, I would do the research for you. I don't have the numbers at the tip of my tongue.
I would love to see that. Thank you, because the 7 million is a drag on our budget for other things that you need and we need. But I've been worried that it would be going up increasingly as more and more big businesses use it. It was structured so that it would work better for the small businesses originally. Thanks.
Okay, the next question is from Representative Amanda
Gorg.
Gorg, okay.
I want to thank you all so much for giving a very realistic perspective on what's happening. I too am a small business owner on the Seacoast, and I'm curious, as we're talking about wages, I know it's very different throughout the state, and we've gotten a lot of statistics over the past day and a half, and where our income lies throughout, where our poorest people are, where our more wealthier people are. And I'm curious, especially because you guys are on the other side of the state, how much as a range do you actually pay your employees? If you're comfortable in saying this.
So in our case, starting employees about 16, the most experienced person on the floor is probably getting 23, 24. And right now, we're operating on an overtime situation. So, they're adding another 10 hours a week at time and a half. So, we have people that are making $50,000 to $60,000 a year, as factory workers, with, us paying 70% of the health insurance premium and having an ESOP plan in place and everything else. So, and we've checked against, the market here, looking at the state's, input as to average wages for different types of jobs and different geographies. So we try to be, slightly above the average wage for the type of work that we have here, so that we can be a little bit more competitive in getting the better quality people.
Tom?
In terms of the hourly, I mentioned before, our hourly typically start, and these are direct labor people, anywhere between $18 and $20 an hour to start as well. But we have direct labor people making $21, $22 an hour. We have a graded system that we bring in a third party to review our jobs, so that, and we also look at regional values, what people are paying for an hourly job in, say, Burlington or Nashua, or whatever. We want to be, as a company, the company of choice. So we try to typically pay more than any of our competition. We also have, of course, exempt employees that could be making up to $60,000, $70,000, $80,000, $90,000 a year, depending on where they are, whether they're engineers or whatever they may be. Because again, we have a wide spectrum of type of jobs at this type of company.
Yeah, even in my small company of 21 people, I have salaried employees making $70,000, $80,000 a year. So,
Cheryl?
And I can tell you here at our organization, everyone is, everyone, we don't have hourly folks. They're all exempt, and, they range from coming in, beginning $34,000, $35,000 a year up to as high as Val had said, $75,000, $80,000 a year. Not, non-senior level people, but just, coming in, and most of our rates, as Tom has said, they're market based. What do I need to pay to have the best of the best compared to my competition who's trying to take the people from me? Right? I'm not going to let a minimum wage drive that. I'm gonna let the market drives that. No different than what you'd sell your product for.
Yeah, and for our hourly wage people, you can probably add $5 an hour for benefits and taxes and things that we have to pay for every day. So effective cost of somebody on the shop floor could be, $22 to $30 an hour, just on the benefits plus salary.
Yeah, if you add that into our wage package as well, Val, yes, correct, because we, and as the Lawson Group, we pay 100% of our employees' health insurance. We contribute 5% for a 401k. We do a profit sharing every year to the extent we're able to. So I mean, you can add 15 to 20% just on, additional benefits, over
and we have to do that. I mean, I pay more in health insurance premium for my employees than the profit of my company. So
absolutely.
So the health insurance premium exceeds the bottom line profit at the end of the year.
Mm-hmm.
I mean, last year, 2019, we made about $30,000, and I paid out $90,000 in health insurance premiums. So, the cost for us to run our businesses, to do all the things we need to do, insurances, benefits, competitive wages, it's quite high. It's quite high. Plus I have all the fixed expenses. I have, electricity and equipment and, all the, leases and things I pay on equipment. So we're looking upwards of $55, $60 an hour for every person on the floor of total cost to support that person. So we try to price our product at about $100 per hour value, so that the difference of 40 then pays for the non-manufacturing people, the office people, the salespeople, the engineers, and everything else. And at the end of the day, if we have 3% left over on the bottom line, we've had a successful year.
Dave, do you have anything you want to say to wrap it up?
No, just greatly appreciate the opportunity to talk to you a little about what's going on in New Hampshire's manufacturing environment. And I think you've heard both some good news, but also some challenges ahead for 2021. And I want to encourage any committee members, if you are interested in talking to an employer or manufacturer from your district, just give me a call and I'll try and match you up. Thank you, Mr. Chair.
Well, this has been very, very helpful to us, and we appreciate the Val, Cheryl, and Tom coming in and explaining their business and their challenges. And thank you.
Our pleasure. Thank you.
A pleasure. Thanks for the opportunity.
For the committee, we can all, when I'm through, you can all mute yourself and mute your video, and we'll start again at 1 o'clock. And at 1 o'clock, we'll be listening to Ben Frost, who's Managing Director of New Hampshire Housing Finance Authority. And then after that, we'll talk to Patricia Tilley, Deputy Director, Division of Public Health Services, Department of Health and Human Services, primarily discussing the pandemic. All right, we'll see you back at 1 o'clock. Thank you. So just mute your video, audio and your video.
Jennifer, are you still there?
Representative Ulrey, this is Chris Shea. Jen is on a phone call, so she's unable to talk at the moment.
Yeah, I just noticed down on the mute button, it says that if you hit your space bar, you can unmute real quick. Maybe that should be another little announcement that can be made. That's just a suggestion.
No, you're absolutely correct. That is one way that if you wanted to speak temporarily to say, ask a question, you can push that down and it will unmute you. And then once you let it go, you'll be muted again.
Yeah, no problem. Thank you.
You're welcome.
Bye.
Bye.
Hey, Chris, are you still there?
I am Representative Major.
Would you get a hold of Jen and ask her if she could get a hold of Joe Gimmel to have them provide the slides that Jeffrey used?
Yep.
I could do that, but probably let's try her, and if that's an issue, then I will do that.
Sounds good, Representative Major. Yeah, we'll follow up and see if we can get them, and either she or myself will let you know if there's any issues with that.
All right, thank you.
You're welcome.
Susan?
Hi. I'm sorry, yesterday I didn't understand. I thought you were going straight through 12 o'clock.
You got to see the inauguration.
Well, no, I missed the oath swearing, but I've recorded.
Representative Major, I just wanted to let you know that Mr. Ben Frost is in attendance, and I've moved him into the panelist list so that he can just be prepared for when you introduce him.
Okay, thank you. Jen, let me know when we can start.
You can begin when you're ready.
Okay. Since we didn't adjourn the meeting, I don't have to read the entrance all over. So we're privileged to have Mr. Ben Frost, who is the Managing Director of Policy and Public Affairs at the New Hampshire Housing Finance Authority, where he manages legislative initiatives, communications, research, and strategic planning, and also serves as the internal legal counsel. He will discuss the state's housing market and housing challenges. Mr. Frost.
Thank you, Chairman Major, and good afternoon to you all. It's, I think, the first time I've appeared before either a House or a Senate committee in this manner, although I've been testifying before your committees for an awfully long time, a couple of decades, it seems.
It's a new way of doing things.
It is, and we're all keeping safe, and that's a good thing, I suppose. So our executive director, Dean Kristen, very much wishes he could be here with you today, but he has board of director meetings that he's attending to, so he has to be there, and so I get the pleasure of filling in his shoes today. Good. And what you've asked me to do is to talk about the housing market in New Hampshire and some of the issues related to the housing market. So I've prepared a PowerPoint presentation, which I've shared with Jen, and I'm going to share my screen with you now. And I believe you can see that.
It looks like it's coming up. There it is.
There it is. Okay. So just first off, for those of you who are perhaps unfamiliar with New Hampshire Housing, we're not a state agency, but we are created by state statutes. We were created by the legislature in 1981 as a a self-sustaining public corporation. So we're an instrumentality that fulfills important governmental functions as defined by the legislature. We have a 9-member board of directors who are appointed by governor and council. And there's our mission, which basically is to help ensure that everyone in the state has a safe, decent, and affordable place to live. And we do that by administering a variety of different programs, ranging from rental assistance directly provided to tenants or through landlords, providing assisting with home ownership, and upwards of 2,000 households every year we assist. We finance, we don't build housing, we don't own housing, but we finance multifamily rental construction. And we do something on the order of 500 to 1,000 units a year. And we oversee a portfolio of 400 projects totaling about 15,000 units. We also do a lot of research on the housing market. And really that's why I'm here. That's the group that I head at New Hampshire Housing. And so we provide research and technical assistance to the public and to you, the legislature, to help you make informed decisions on the housing market. Over our history, we've helped more than 50,000 New Hampshire families purchase homes. We've created 15,000 multifamily rental housing units and provide direct assistance to tens of thousands of households. And here's some of the data from this year, this past year, FY 2020. So we're an active organization. And we have an impact on the New Hampshire economy, on something on the order of $700 million every year. And so that's we're an important part of what goes on in the real estate market in New Hampshire, and it's a mission that we take very seriously. Now, with regard to the housing market, I'll talk about the rental market a little later on, but I want to start with the discussion about the purchase market and what's going on there. And well, what is going on there? That's a really good question. We read the headlines in the newspapers, and my goodness, the market is red hot. A colleague of mine in our homeownership division, I like to say that November is the new June, and typically speaking, we would see prices falling off in the winter months, starting in October, November, because people just weren't purchasing. There wasn't a lot of demand. They're going up now, not going down. And there's a lot of reasons this might be happening, and we'll take a look at a couple of those. But you can see that the November figures are up 17% over November of 2019. December figures just came out, and it's pretty much the same thing, up about 17% between December 2020 and December 2019. And that's the median sales price of a single family home in New Hampshire. The market is different. It's behaving differently than it has traditionally. And we're fascinated to figure out why that is. Well, part of the issue is, it is a classic supply and demand issue. Listings are down substantially. And this is particularly impacting the lower end of the market. And by lower end, I mean homes that sell for $300,000 or less. And for the first time in an awfully long time, that inventory has fallen below the homes that are available above $300,000. Now, part of that's, we're not controlling for inflation here, so that might yield a slightly different graph. But the fact is that the price that homes available on the market that are listed on the market at below $300,000 are very few and far in between. They're hard to find. And that has an impact on, in particular, first-time home buyers who haven't developed equity. They're not moving up. They're trying to get their foothold into the purchase market, and it is really, really tough for them to do. Closed sales, well, yeah, if you look at the way things have been over the past couple of years, again, we would see the sales dropping off in the winter months. That is not happening now. Even though the inventory is low, sales are still very high. It's kind of a conundrum where that has implications on the sales prices. So again, supply and demand. The amount of time that a house might spend on the market, I've lived in a number of different homes and sold them from time to time as I've moved from place to place. Sometimes I've been really lucky and sold it. One house I sold the day before it came on the market, but that's really what's happening right now. A lot of homes are being scooped up as soon as they come on the market. The average right now is under 1 month, which is very fast. This is the months to absorb inventory is a kind of an industry standard way of looking at the inventory. And this is the amount of time it would take to sell the current inventory at the preceding 12 months pace of sales. Now recognize that the first half of 2020 was kind of slow for obvious reasons, but then starting the middle of the summer it really picked up fast. So if we were to look at the current pace of sales, it would be substantially less than what's shown here. It would be less than 9/10 of a month for those properties under 300,000, less than 1.2 months for the properties, for all properties. This is, it's really shocking what's going on with the purchase market. And what's driving this? Interest rates. This is the principal driver. There are other factors too, but the very low interest rates that we're facing, the historically low interest rates that consumers have available to them, is what is driving the market right now. So you see this interest rate at 2.68, and this is a national survey done by Freddie Mac. This is the lowest it has been since Freddie Mac started doing this in 1971. It's really low. And you might have heard Fed Chairman Jerome Powell last week say that the Fed is not exiting this strategy anytime soon. So the federal funds rate is close to zero. It's going to stay there for the foreseeable future until conditions dramatically change. I want to take a moment to talk about foreclosures because this has been in our minds for a long time since the Great Recession and the foreclosure crisis that so many families in New Hampshire and nationally faced. During the 4 years of technically speaking, the recession was like 12, 14 months, but really the 4 years in and around the recession, roughly 20,000 New Hampshire families lost their homes to foreclosure. And we've seen this trend going down slowly over time as the economy has improved, as people's employment and income situations have improved, as people have gotten their financial feet under them more firmly. We've seen a drop off in foreclosures. And right now things are very different because we have the option of forbearance for anyone who has a federally backed mortgage. And earlier in the year, there was the foreclosure moratorium that also had a significant impact on what was going on here, obviously. Prior to that, we would have estimated, we did estimate that we expected to see something on the order of 600 foreclosures in New Hampshire in 2020. It turns out, and this is not complete data for the year, but it turns out we'll be looking at something on the order of 250 or 275 when we compile those data. But this is the important thing to consider here is this is really a seller's market. So there's really not a good reason for anyone to be faced with the prospect of foreclosure. If you have to sell your house, you should be able to sell your house in this market. What we're seeing is that most of the foreclosures that are going on right now, the few that are happening, are of properties that have been abandoned. So the owners have simply left and they've turned it over to the bank to deal with. It may also be the case where we're seeing some level of foreclosures in properties that don't have federal backing. And so that aren't backed by FHA or Fannie or Freddie or the VA. And that's about 30% of the first mortgage market in New Hampshire. And a lot of those may be manufactured housing as well, because most of them are not eligible for federally backed mortgages. That may change in the future, but that's the situation now. I have read for the past several months, since the summertime, countless articles, headlines, statements from realtors and journalists and reporters. It's the Massachusetts buyers that are driving the market in New Hampshire. And so we started looking at these data. And over the past 5 years, roughly 3/4 of all purchasers in New Hampshire came from New Hampshire, someplace in New Hampshire. 15% over that period came from Massachusetts, and every other state contributed about 1% or less for a total of 100%. Now compare the annual data over the past 5 years. And my question to you is this a flood of home buyers from Massachusetts? I don't think so. There's been an uptick, certainly, in the number of the proportion of buyers from Massachusetts, but it's certainly not a flood. And the 2020 data are through mid-October. And so we'll continue to analyze this, but I don't really expect this to change dramatically. What's going on here? It's not so much the Massachusetts buyers, although they may have an impact on the higher end of the market. So there may be some price stratification going on here, where the buyers from Massachusetts are competing more for the higher end housing and less for the lower end housing. Really, I think what the greater impact on New Hampshire is not in the purchase of homes by people from out of state, but the occupancy of those homes by people who already own their second homes. They may be working in Metro Boston, and they decide, March comes around, the pandemic strikes, and they say, well, we're pulling the family, taking the kids out where they're learning remotely anyway, taking the kids to go to our lake home on Winnipesaukee. And I think that is having an impact. And early on, we heard from people up in the North Country, there are people here now who aren't normally here. And they were saying that in March, April, May. Those are the people who vacation up north, don't live up north, but they're living up north right now. And that definitely does have an impact on New Hampshire, but not so much an impact on the home buying market. Now let me turn to the rental market and take a look at that. And most of the data that I have here comes from our New Hampshire Housing's Residential Rental Cost Survey, which we do every year. We survey landlords, and the data set is about 20,000 units. We filter out some anomalous figures and control for size. So we use a sample of about 12,000 units. So it's a very robust survey, and really the best source of rental data that we have from any source. And what you see in the rental price trends is this slow, steady, inexorable, it seems, trend upward. And if we were to go back farther in time, through the Great Recession, back into the early 2000s, back into the mid-90s, you would see this steady trend of price increases. So even during the Great Recession, and you think about that, well, I said earlier, roughly 20,000 New Hampshire families lost their homes to foreclosure. A good number of those went into the renter market. So that had a significant impact on price and availability. So you see this ongoing trend, and part of this is reflected too geographically. The 4 southeastern counties in the state. It's where the bulk of the people live. It's where the bulk of the housing units are, and that's where the bulk of the cost is. So Rockingham, Stratford, Merrimack, and Hillsborough counties, and you see the change in prices occurring there, pretty substantial. 28% increase over 5 years. In Rockingham County, 26% in Hillsborough County. But go up to Coos County too, a 12.5% increase. That's a pretty healthy increase. And it's a good for the property owners, tougher for the renters, certainly. It said, Coos County obviously has the lowest median rental cost of any county in the state. And it's often said, well, that makes it the most affordable. Well, in comparison to statewide incomes, yeah, it is. But if you're looking at the incomes of the people who live in each county, Coos County is actually the least affordable county in the state. Housing problems exist all over the state. I also would want to point out Grafton County is very much a tale of 2, maybe 3 counties, because you have Hanover and Lebanon in the southwest corner of the county, which are really driving a local economy there, a local housing market, and increase overall the median and that we see represented here. Elsewhere in Grafton County, the rents would be substantially less in many locations. Another aspect of the rental market is the vacancy rates, and we consider a 5% vacancy rate to be something where the market is balanced between the interests of the landlords and the tenants. 3% is pretty much a turnover measure. It's the time that a landlord has to take to prepare a unit for a new tenant after an old one moves out. And you look, for the past 7 years, we've had a statewide vacancy rate of below 3%. This is not an indicator of a healthy rental market. It's an indication that supply is significantly below demand. The increase that we see between 2019 and 2020 of 1% from 0.8 to 1.8, that's perhaps a good sign. It may be an anomalous trend, but we'll take it as good news. And maybe this is attributable to the multifamily construction that's been going on in places like Londonderry and in the Seacoast. That remains to be seen. And if you look at the vacancy rates by county, you see that they're low everywhere. There's no exception to this case. And in comparison to the region, the Northeast region and the United States as a whole, our vacancy rates are way below those averages. And this all has an impact on affordability. If you're making the median income of the state, so $82,000 for a family of 3, you can afford pretty much everything that's on the market at a 30% cost burden. But if you're making only half the median, $41,000, you can't afford a whole lot. You can afford 11% of what's on the market. And if you're making $25,000, you can't afford just about anything that's on the market. And recognize that as the less money you make, that 30% consumes relatively more because you have less actual money left after your rent has been paid. There's a common expression now in some circles of advocates and academics that the rent eats first. So for people who are faced with the prospect, well, I'm going to pay my rent, or am I going to pay my auto insurance or make that auto repair? I'm going to pay the rent first. And then whatever's left after that goes to the auto insurance, the health insurance, the medical bills, the prescriptions, food for your kids. So if the demand is so high and why aren't builders building? Well, you can see the builders really are not building at anywhere near the pace that they had been before. The black line is single family homes, the brown line is multifamily, and this is units being permitted. So a 10 unit multifamily project would be counted as 10 units on this graph. And we just haven't recovered. The market has not recovered. The development market has not recovered since the Great Recession for a variety of reasons, which we're still exploring. This really is fundamentally a question of supply and demand. The question is why? Why aren't builders building? Well, my colleague here at New Hampshire Housing, George Regan, likes to cite the 5 L's that he calls, as he calls them. And some of these we can have some influence over. Others we can't influence so much. We can't influence the cost of lumber and other construction materials. We can't really influence supply chains that much. We can influence somewhat more workforce availability through training programs and the like, or financial incentives maybe to certain industries. But there's just so much we can do there as well. Banks are ready to lend to any developer who is willing to have taken the risk. Banks are willing to lend for projects that are ready to go. And that's really the issue. Developers have to take the risk up front before they can get bank financing. And I'll tell you, that's not a business I would want to be in. I don't have that appetite for risk that developers do. And that it is a significant risk for any developer to pursue a project. It may cost several $100,000 just to get through the permitting process before they even get to bank financing to build. So what's the risk here? Well, land costs, yeah. And can we control the market? No. Or can we? Regulatory practices, in particular at the local level, do have a significant impact on the cost of land. And so to the degree we want to influence costs of land and reduce developers' risk and increase the supply of housing, we have to deal with, in particular, local regulatory practices. And it's both zoning and subdivision regulations and site plan regulations and how they are implemented by the boards that do this. So just to summarize all of this, we have a couple of really important issues: very high demand that's fueled by interest rates. And I didn't cover it here, but there is some evidence of more conservative consumer behavior after the Great Recession. And I know you've got a presentation this morning from Phil Sletton, and he talked about still families not saving, but their credit scores on average are a lot better now than they were during the Great Recession or after the Great Recession. They have improved. People seem to have learned some better behaviors on average. And that puts them in a better position to be able to buy a home. And we're seeing some evidence of that now. But we're also likely to see what we're calling a K-shaped recovery. People on the higher end of the income spectrum likely to do okay. People lower down, less likely to do okay. We also have this constrained supply as a significant issue. Underproduction for a long time has left us with a deficit we estimate to be 20,000 units statewide just to meet current demand. Forget about future growth. This is just to bring balance back to the purchase and rental markets. We would need another 20,000 units. And here are the contributing factors, which I've already talked about. The implications, Chairman Major, you mentioned yesterday in one of the presentations I was listening to, if we don't have housing, we can't get workers. That's really a fundamental problem that we face right now. The housing supply is having a negative impact on economic growth. It's a constraint to economic growth. And we know how much we need to grow our economy to, among other things, make lives better, but also to fund the state's budget. I focus in particular on the rental market. We need to have a really, what I would call a fluid rental market because it helps with labor mobility. It provides an opportunity for people to move into a town before they decide what they want to buy, where they want to buy. You get a job, say you get two job offers, one in Lebanon and one somewhere in Ohio. And you look at the housing market in Lebanon and you say, well, I can't even afford a place to rent. I'm going to take that job in Ohio. And you got a 20% raise without actually making any more money. And I've said this already, but the affordability issues that are propounded by this lack of supply has the greatest impact on people of lower income. It affects their stability of housing, it affects their kids, and threatens them with homelessness. These are problems that we have to deal with. I don't want to leave it on that dark note. So let me just give you a couple of possible solutions. One, the legislature has already done, and this is the establishment of the Housing Appeals Board to make it easier for people who face adverse decisions locally to get a day in court using the same legal standards that Superior Court applies, but doing it in a faster, more efficient manner than the courts can do. The Housing Appeals Board opened its doors to appeals just last week. And another one is Representative Joe Alexander's bill, which is House Bill 586. This is a combination of two bills that were making their way through the legislature last year. In fact, one of them had just come out of the House Ways and Means Committee with a unanimous ought to pass with amendment recommendation. And both, it looked like we're going to proceed and get adopted. But then they, like so many other worthy bills, fell victim to COVID. Representative Alexander has combined those two bills in this one piece of legislation, which will go to the House Municipal and County Government Committee sometime soon. So I look forward to seeing how that works. And I'll be happy to take any questions and try to give some answers.
Well, thank you, Ben. You've provided us a lot of good information on our state of our housing. We do have at least three hands up. And the first questioner is Representative Bromney. Representative Bromney, you have to unmute.
I got it. Thanks, Norm. Great presentation. Appreciate it. Back to the 5 Ls. I like that, the 5 Ls. I think we could do something about labor. We talked about it a bit yesterday in terms of training and all that. The laws, we've heard this in the past about permitting, and I've heard it directly from builders. And it depends on your town. It gets pretty complicated. What's a mystery to me is land. I mean, land, I know our land, the dirt itself is worth a lot, especially in Rockingham where I am. What's the hesitation? What's the holdback with the land? Is it the cost of the land, or people unwilling to sell their land? Can you just enlighten us a little bit on that?
Well, thanks, Representative. This is a really good question, and there's not a simple answer to this, but the cost of land is part of the development equation. So you might choose one parcel of land over another if you're a developer, but really the point I'm making here is that the cost of land does not exist in isolation from other factors. It is influenced by other factors. A good part of it is simply market demand. So all other things being equal, including local regulation, a parcel of land in Rockingham County is going to be more valuable and therefore more expensive to purchase than a parcel of land in, say, Coos County. That's just the market. The question, though, is what is the influence of local regulation on the cost of land? So you might say, I've heard some towns saying, well, we're built out. According to your current regulations, yes, you're built out. But if you came up with different regulations, then there's tremendous opportunity for additional development. And some towns might say, well, we don't want that. Okay, I get that. That's your choice. But you can't deny that regulations don't have an impact on the cost of land. And that's really the point I'm making there.
Okay, thank you. That's good. Thank you.
Okay, Representative Ames.
Thank you. And thank you for that great presentation. So my question has to do with the property tax, the local property tax, and how it might affect the rental price, the rent that's charged from town to town. We know that the property tax varies enormously from town to town. So, the price in Claremont or in a number of towns that I could cite where the tax is very high is very different from the tax that's going to be paid by a landlord in Portsmouth or or any number of towns at the other end of the tax spectrum. So I'm just wondering how that translates into whether you've studied this issue of how property taxes feed into the price that has to be charged by a landlord.
Well, we've not studied it as part of a comprehensive study, but we do study it with every project that we underwrite. So when we're financing the development of a multifamily housing project, we very carefully underwrite those projects for a period of 20 years. And the property taxes do play an important part of the development costs, as do operations and other factors. So, you know, it does form part of the pro forma, if you will, of any development that we look at. And you're right, that the property taxes do vary substantially from one community to the next. But there are also sometimes countervailing factors. So you used Claremont and Portsmouth as two examples. Well, the taxes, relatively speaking, paid on the property in Portsmouth might be less than the property paid in Claremont. The property in Claremont is going to cost you less at the outset than the property in Portsmouth. So there is some balance between those two things. One thing I would want to say about the property tax, and this is in particular with regard to the development of new housing, and especially rental housing, it is often cited by opponents to those projects at the local level before a planning board or a zoning board of adjustment. Well, all those kids that are going to come with this development, we've got to pay to educate them. There is some mythology associated with this argument because it's not really based in fact. This is something that we have studied in some detail. In fact, we have a series of studies that were done by Russ Thibault a few years back. The most recent one, I think, was 2012, where we look at the impact of new residential construction on school population. And where we see the greatest impact on school population is in association with large single family homes. It's really related to bedrooms and the capacity of a home to accommodate kids. Smaller units with fewer bedrooms tend, as you might expect, to have fewer kids associated with them. And the type of construction, the type of building also influences the number of kids that are in those units. So a multiplex, multifamily rental project with a bunch of 2-bedroom units is going to have, on average, far fewer kids than your typical single family home. And do the math, the tax revenue you get from these multifamily projects is pretty substantial and probably on average outweighs what you get from single family homes. And we have done some additional analysis on that, and that's available on our website.
Okay, before we go to the next one, you mentioned Russ Thibault. We were going to have Russ make a presentation over the last 2 days, but he has a medical issue right now, and we'll have him back later. Exactly. Yeah. You didn't really mention what's the variation in buildable land between the north and the south part of the state, because I know that where I'm from, and right next to the Massachusetts border, if you have a buildable piece of land that's going to cost $150,000. Obviously, you don't put a $150,000 building on it. You'd probably, to make it worthwhile, it'd be like $300,000. So now you got a $450,000 home. So what is the range of differences in buildable land costs between the north and south?
Chairman Major, we haven't looked at that, but that would be relatively a simple exercise, I think, to look at available land cost, what's on the market for raw land. We could certainly pull some of that data and get that back to your committee.
Okay, thanks.
Happy to do that.
Representative Alme.
Thank you. I'd just like to say something about that from our section of Grafton County, which is incredibly expensive for our area. And we are actually a kind of an island with difficulty of commuting in winter that is considerably worse, I think, than in the east and south of the state. But a lot of our land is subject to major wetness. It's hilly, it's rocky. Most of our hilly areas get enormous amounts of rain flowing down and creating floods. And the developers that come from outside, which is all of our developers at this point, I think, maybe not, don't notice that, which is one reason that the costs come in a lot higher in the end if they keep up with that. So a problem with our regulators being considered uncooperative by some developers. They complain about it, but when they build, we get floods. So on the problem that what I wanted to ask about was, you mentioned the Housing Appeals Board, you mentioned 1632 and the companion bill in municipal and county. You did not mention the 5 million added into the budget for the first time in 15 years, 20 years for the Housing Authority. And when I came to you last year while we were doing the then Griffith and Alexander bill and asked you whether we could take some of that 5 million to pay for things that were in that bill. I was told that you really needed that 5 million for the stuff you've got it for. So I presume that that's something you want to see. I'd love to see you keeping that also. But I'm worried about the blank check that was in the bill last term for building, and that we cannot calculate the cost of, and on how it could get budgeted. Thanks.
Thank you for that. And yes, I didn't mention it in part because we generally leave the advocacy for funding to others. We, as an institution of the state, we choose not to go to the legislature asking for money. When we are asked to, we happily testify on what we would do with it if you, the legislature, chose to make those appropriations. So that said, we're really grateful that the legislature has allocated $5 million annually out of the real estate transfer tax revenues for the Affordable Housing Fund, which is the state's affordable housing trust fund administered by New Hampshire Housing on behalf of the state. We use that for financing of multifamily rental housing construction. And it is honestly the most flexible source of financing that we have and to do financing of housing construction. It is the legislature's choice to do what it wants with the revenues that it gets from the sources it determines. So the legislature has chosen to do this with $5 million a year. If you chose to do something else with that, then that means we would finance less housing construction, and that's the bottom line. It is a linear equation. So more money means more housing, less money means less housing. And I won't address the priorities question because that's really a political question for you all to address and is beyond my pay grade, certainly.
Okay.
I'd just like to point out on that your financing has been key in getting an awful lot of housing for the median income on down in the last, well, forever, but there's been a lot more of it this last time.
I appreciate that, Representative Almy. We use the Affordable Housing Fund to leverage other funds, and the leverage is pretty substantial. It ranges from 5 times to 12 times, depending upon the project. And in certain circumstances, it allows us to finance projects that otherwise would not happen because they can't get financing from other sources, such as things that we call special needs. So housing for people with developmental disabilities, or housing or substance use disorder, people exiting mental health institutions. There's really not much funding elsewhere for that kind of housing. And we use the Affordable Housing Fund for those purposes, in addition to, plain vanilla run-of-the-mill affordable housing for people who need housing.
Okay. Any other questions? So now, well, thank you, Ben. Good presentation.
All right, thanks very much.
Thanks. Now, has Patricia Tilley shown up? Jennifer?
Yes, she's here waiting.
Oh, good.
Good afternoon.
Patricia Tilley is the Deputy Director of the Division of Public Health Services in the Department of Health and Human Services. She's going to discuss the pandemic conditions in the state and the status of vaccine distribution.
Great. Thank you so much for inviting me here today. Thank you, Chair. Thank you to the honorable members of the committee. I'm going to take a moment and share our screen. I will turn off my video while I'm talking, just so you're not distracted by me looking at my notes, and then I'll pop it back on when I'm done. So let me turn off the video and get this screen share done.
All right.
There we go. I think we're up and ready right now. So thank you again for inviting us here today to do this brief update on our public health response to COVID-19 and our plans for vaccine distribution. We know that stopping a pandemic requires all the tools that we have available to us. Granite Staters have been wearing masks and social distancing. Businesses have implemented new policies and procedures. Healthcare workers have heroically served on the front lines caring for patients. All of this has helped reduce exposure, but even these measures are not enough. A public health approach to preventing, mitigating, and controlling this virus requires us to use the full spectrum of public health functions and resources. We start with our assessment roles and collecting, analyzing, and using data to make informed decisions. Critical to our response has been the transparency of this data that I hope that you have all found on our newhampshire.gov COVID website. And we finally assure that all New Hampshire residents have equitable access to the services they need. In the case of COVID, that means safe places for employment, access to testing, high quality medical care, and now vaccine. RSA 141 provides DHHS with the authority to prevent, control, and mitigate communicable diseases such as the coronavirus because of the unnecessary risk to health, life, and the orderly workings of business, education, and government. So let's jump into the data then. Today is the 313th day of our public health emergency that Governor Sununu declared on March 13th, 2020. It is also the 1-year anniversary today of the first case of coronavirus in the US that required hospitalization. There have been more than 24 million cases of COVID diagnosed in the United States and over 400,000 deaths. COVID is among the leading causes of death nationally and here at home in New Hampshire. Comparatively, New Hampshire is doing better than many of the states across the nation right now in the average daily cases in the past 7 days. So that leads us to New Hampshire data. And you can see that we hit our highest daily counts back in December and early January. Our cumulative count of total cases since the beginning of the pandemic is more than 58,000, just almost at 59,000. Last night, we announced that we processed 877 new cases and 334 cases specific to January 19th. This is a decrease from the past 7 days, which is good news. To give some context to these numbers, back in the summer, we were routinely having a daily case count in the 20s compared to our current average of around 600 some odd cases per day today. To the relief of our healthcare system, COVID hospitalizations have been trending downward after the hospital census was over 300 for most of late December and early January. We are now seeing hospital census at around 250 individuals per day. Our hospitals have worked collaboratively to shift the burden from some of the highest impacted hospitals in Manchester, Nashua, Concord, but we are not out of the woods quite yet. Meanwhile, when we look backwards a little bit previous to the increased cases we've been experiencing since December, we can see how clusters in workplaces and among gatherings really impact thousands of New Hampshire residents. Since the beginning of the pandemic, more than 7,000 New Hampshire residents have tested positive for COVID-19 as a result of a workplace or community-based cluster. The data snapshot that's on your screen right now is from September to November, and it highlights that clusters continued in every sector, from community settings that include churches and sports teams, to restaurants, to education and childcare settings, and healthcare settings such as hospitals and long-term care. You can see that in this time period, the greatest number of clusters occurred in those community settings, but the largest number of individuals with COVID occurred among clusters in healthcare and specifically in long-term care facilities. So here we are now. You know, we are at a place right now that we are seeing a more highly transmissible variant of COVID. It's been detected in over 20 states across the country, including Massachusetts, Connecticut, New York, Pennsylvania, and Maryland. The increased transmissibility of these variants that we've seen in the United States and in other places in other countries suggests that we need to keep vigilant with compliance with mitigation strategies, including distancing, masking, and adherence to the safer at home guidelines that were developed with the governor's reopening task force. Again, we are not quite out of the woods yet. But to keep us safe for now, and as part of our efforts to mitigate the effects of COVID-19, Public Health has participated in and provided technical advice to our governor's reopening task force. The public health role was to support the task force as they develop guidance for each industry sector that is supported by both science and data. The safer at home universal guidelines have provided the required steps businesses need to take in order to operate safely for their employees and the public. The guidelines have evolved with the science and with changes in the pandemic, but focus on keeping potentially infectious people out of public workplaces through screening and quarantine, through cleaning and disinfection, through modifications to processes and policies, including social distancing and the use of masks, and finally, quarantine and isolation requirements for those with COVID-19 or close contacts are the structure that all of our businesses are using right now to keep safe. The star of the show right now is vaccine, and I think that's the thing most people are interested and excited about. We at Public Health are excited that vaccine is already in the arms of more than 70,000 New Hampshire residents, including our healthcare providers, first responders, residents and staff of long-term care. Just yesterday, 1,600 individuals were vaccinated at one of our 13 fixed sites around the state, where we work in partnership with the National Guard and the Department of Safety and others to make sure that we have accessible vaccine in every corner of the state. By getting vaccinated, each of us help end the damage to the economy and prevent more illnesses and death in New Hampshire. As we walk through some of the highlights of New Hampshire's approach, keep in mind the following. The safety of COVID-19 vaccines is a top priority. The 2 doses of vaccine right now will help protect you from COVID-19. And there is currently a limited supply of vaccine, but supply will increase within the weeks and months to come. But this limited supply right now is why we are prioritizing some groups over others for those first doses. And finally, the vaccine is important, but no one tool is going to stop the pandemic. Your best protection from COVID-19 continues to be a combination of not only getting that COVID vaccine when it is your turn, but continuing to wear that mask, staying 6 feet away from others, avoiding crowds, and washing your hands often. By now, most of you are pretty familiar with New Hampshire's vaccine allocation plan. As you can imagine, this has been a complex process and decisions have never been made in isolation. Our rollout philosophy has been to keep people from dying, to impact those most vulnerable to the risks of COVID-19, and to keep our healthcare system up and running so that it is ready for all of us if and when we need it. With those goals in mind, you can see that we prioritized those most at risk for the worst outcomes. In 1B, we're focusing on residents 65 and older and people with significant health risks. And we focus on those that cannot social distance, those in our long-term care facilities and residences for people with intellectual or developmental disabilities and correctional facilities. Vaccines are administered in a variety of settings, including our hospitals, within our healthcare provider offices, through pharmacies, and of course, the state-run fixed sites like the one we have right here in Concord in the parking lot of the Steeplegate Mall. It will take a while to get through this population of almost 250,000 people, but we anticipate that we'll be able to move into phase 2 in March and phase 3 throughout the spring, later in spring and in the summer. The limited supply of vaccines from the federal government means that appointments may be booked weeks out. Everyone in phase 1B who wants an appointment will get an appointment. And if allocation should increase, appointments will be rescheduled to earlier dates and times. 211 is ramped up as a call center to help with registrations for the 1B population. And those calls and that registration starts this Friday. We hope that most folks will use our website, but hundreds of state agency staff and the National Guard will be ready to answer the call come Friday and in the weeks ahead. We will be prepared to answer questions and help people manage and get those registrations moving forward. By this fall, we hope that we have a significant number of New Hampshire residents vaccinated and that community spread will decline from the numbers we see today. If there is anything we've learned during this pandemic, it's to be flexible to change. Our partners, the National Guard, hospitals, long-term care providers, community members, and the residents of New Hampshire have been extraordinary. We are all eager to take this next step from 1A into 1B and beyond. And as we get that supply of vaccine, we will get the doses out. We literally want to roll up our sleeves to protect our families and our communities. And we want those most in need to be in the front of the line. And if there weren't already enough benefits to getting vaccinated, employers and employees should know that after you pass the 2-week mark from your second dose of vaccine, you no longer will need to quarantine if you are identified as a close contact or if you travel outside of the New England states. Vaccination provides a pathway to reduce the spread of disease and to get back to some sort of normalcy for businesses and the public. I encourage you to also check out some of the excellent resources that are available on our COVID-19 website, including this FAQ for schools, businesses, employers that was developed by the Attorney General's office and answer some of the questions that our employers are wrestling with right now. In the Cliff Notes version, we are strongly encouraging individuals to protect themselves, their family, and their community. You'll see confirmation that the state does not intend to mandate these vaccines and generally does not recommend that these vaccines be mandated for students, employees, or customers. And there's a couple reasons for that. First of all, there may be legal complexities surrounding mandates for vaccines approved through an EUA, which is an emergency use authorization through the FDA. There's also a question of equity and fairness when neither of any of the vaccines will be available to the entire population at the same time. We simply do not have enough vaccine right now for everyone. And while it's generally not recommended at this time, however, a business could choose to require a vaccine. This is not unlike healthcare providers who require their employees to have a flu vaccine. If a business is considering this approach, it must be non-discriminatory in nature, and employers may be required to make accommodations for employees under federal laws such as the ADA or the EEOC. If businesses are thinking about going down this path, they should do so in consultation with their legal counsel. An approach we can all take is to remove barriers for employees to access vaccine. That includes ensuring that people have time off work to get the vaccine and that people are encouraged. At the end of the day, the vaccine will protect our families, save lives, and it will offer that pathway to return to the gatherings that are important to us for our physical, mental, and spiritual health. So what's next? Phase B registration starts Friday. Phase 1B vaccinations start next week. We are asking the public to take a look at the vaccine website, the vaccine.nh.gov website, to see when is their turn. And they can go through a little process there to click through some buttons and determine what phase that they likely belong in. We know that phase 1B is a heavy lift. There is between 250,000 and 300,000 New Hampshire residents in this group. And we hope to have the opportunity to offer them vaccine as we have it available. We also encourage all of our residents of New Hampshire to call 211. As I noted earlier, we have hundreds of state agency staff ready to man the phones, working on it right now. We have National Guard folks helping us because we know the interest is so great at this moment. So feel free to use 211 now and to use 211 as we start registration at the end of this week and the beginning of next week. And finally, we ask you all to just stay informed. And I know that this committee, as much as any, has been watching closely through our governor's press conferences and through the updates with Dr. Chand and Dr. Daly. And we have tried to be as transparent as possible on our website to provide all the information that folks need as we know it. So I will stop my share right now and I will turn back on my camera, and I'm happy to answer any questions that you may have.
Let me ask the first question, Patricia. Is it possible for you to go back, I think, to your third slide, the one which shows the 60 to 69 age group, 70 to 79, 80 plus?
Okay, let me pull that up right there. And I think you were, which slide you were for?
Shows the one with the number of deaths per age group.
Yes, yes, I will pull that up for right now. And here we go. Whoops, maybe not. We'll go backwards this way. I think all of us are mastering Zoom in new ways these days. Here we go. Is that the slide that you were interested in?
Yes.
Thank you.
It shows the number of deaths in the 60 to 69 age group as so much. And then the 70 to 79 is probably about triple that. And the 80 plus is much, much greater than that. And at one time, 1B group was going to be, for the vaccination, was going to be 75 and above. but it was just changed recently to 65 and above. And where it goes to 65 and above, it's going to be very difficult for those that are in their 80s or in the high 70s to compete with the ones in the 65, a very large group, to get it. And they may end up being, because they're in this group, may end up getting it at the end of the group. Are you doing any prioritizing within Group 1B?
So we are trying to do that. And first of all, thank you for that question and your very appropriate observation of the data. I think there's a couple of ways that we've addressed this. One is working with our pharmacy partners to ensure that we have vaccine at all of our long-term care facilities. And that includes both our nursing homes and assisted living facilities. And we know that they were among our number one population. That was 1A, it was them and the healthcare providers and our first responders. And we are thankful that we have gotten at least first doses out to over 126 of those facilities in the state, and all of them will have had first doses by the end of January. CVS and Walgreens have been great partners. CVS is taking care of about 75% of those long-term care facilities, and Walgreens is taking care of another 25%. But we think that that's that population, certainly generally 75 and older, so 70 and older and 80 plus, that are most at risk, and really, as the data show, most at risk of dying from COVID-19. I think the other point of your question, that we certainly have a large number of folks that are 70 plus, 75 plus, that are not living in a long-term care facility. And as you noted, they're almost in competition now with that 65 and older group for getting signed up. We are hoping to try and make sure that we have vaccine available to everybody who signs up. We know that there's increased risk from 65 plus. We know that just a week or so ago, the federal government, Secretary Azar, had recommended to all states that we focus on that 65 plus population. The other group that is included in 1B is also the medically complex, those who potentially are under 65, but had to have multiple medical conditions. They are also prioritized, and we're working closely with healthcare providers to simplify the way that we can attest to that. So the short answer to your question is that there will be sign up starting on Friday. We have prioritizations within the prioritized group of 65 plus, and we are hoping to get as many vaccines into the arms as many people in this population as possible and as the supply allows.
Let me ask this follow-up, is that I know of some people that are over 85 with at least a couple of these conditions. When they sign up, will they be prioritized? If maybe they try to go on first thing Friday, but they can't get through until Friday night, and by then there was thousands of them that already got ahead of them.
Yeah.
They get prioritized.
We're asking folks if they have questions and they need help and they believe that they should be at the top of the line. Again, we want you to call 211. They will help folks get through that process. We want to be able to be there available to them so that they can get registered. And then after they're registered, those appointments get made as well.
So the advice is use 211 rather than the going online.
You can use both, but if you want to talk to a person who will walk you through that, certainly you are free to call 211.
All right, thank you. Hold on one second. Bring this up. Okay, Representative Bromley has a question.
Thank you. Good presentation. Appreciate it. We're Ways and Means, as you know. We're charged with doing revenue estimates that are going to be based a lot on how quickly things go back to normal. And as we know, we have to project revenues for July 21st July of 2021 to June of 22, July of 22 to June of 23, by the middle of February. So part of the big question that we're going to keep on coming back to is, well, when are we going to hit herd immunity? Now, I listened to the governor last week, last Thursday, and he said New Hampshire was getting about 17,000 doses a week currently. And when I hear 1B is 300,000 people-ish, that's 600,000 doses. That equates to me, I did the math, that'll take over 8 months to do, about 8 months to do, assuming that the number of doses that we are given doesn't increase. So I guess question one is, what's the chances of us getting more doses as time marches on? Because the more doses equals the quicker more people will be inoculated, and the number of, that's the more likely that the state of emergency will end, and thus helping revenues. And the other question I have is about this new strain. That, to me, that could be another fly in the ointment in our thinking is on Ways and Means. Do we know if the current vaccines are effective on this new strain? That's
Great
questions.
Thank you, Representative Abrami. You're asking great questions around the supply. I'll start with that. You're correct. We are receiving about 18,000 doses a week. It is not enough to do all the folks that we want to get vaccine into. The good news, however, is that we expect that to increase. We expect that there are 2 other manufacturers that are right in the wings that should be coming up soon with supplies of new vaccine as well, one of which is a 1 dose, not a 2 dose. So that's great news. Most of us would love to have one shot in the arm instead of 2 shots in the arm. So we are going to be registering people out. We will be using every single dose that is available to us. And we are hopeful that the supply, it will increase over the next few weeks and certainly months ahead of us as new manufacturers come on board and receive their emergency use authorization as well. We are anxious to work with a new administration as of today to ensure that states get equitable supply of vaccine so that we can reach all the people that we need to reach. I think we're all in agreement that this is our pathway out for both healthy people and healthy Main Streets. Your second question about the variants, certainly all of the scientists are keeping a very strong look at this right now and watching the data. As I mentioned, it's throughout the country right now. It has been identified in Massachusetts, it's been identified in New York. We have not identified one of the variants in New Hampshire yet. We have the capacity to do some of the genome sequencing to do that work. So we're getting ready, and we have sent particular samples to be sequenced that have not been identified as being the variant. So we are certainly concerned. The science as of today and the data suggest right now that the vaccine will be effective against the new variant. The main concern with the variants are that it appears that they are more easily transmissible. So again, we are all anxious to get as many vaccines out into the community as possible to limit that transmissibility. It's also the other reason why all of us can't give up on that I'll sound like a broken record, like Dr. Chan sounds like a broken record, like the governor sounds like a broken record. We can't give up yet on the masking of our social distancing and staying away from large crowds of people quite yet. We see the light at the end, but we got to get there. Thank you.
Norm, I have one more question, but I'll let others go first, and if there's time, I'll ask it. Thank you, Patricia.
Representative Almy.
Thank you. I had a bunch of questions too, but on the first thing is there, as far as I've heard a fair amount about this. Sorry about that phone call. There is no evidence yet that the people who are vaccinated cannot be carriers of COVID. So I do not understand how we can tell people not to quarantine once they've been vaccinated completely, which is really going to delay things for our economy. The other one is just following up on Representative Major, our chair. I haven't seen anything in the advertising about this that would indicate that you should call 211 if you're over 75 or you've got a number of the chronic conditions. And I did use your check, and I'm over 65. I will be over 75 2 days before I was going to be eligible before. 65 to 75 is a lot healthier than 75 on up. The people in that age group, those age groups who are at home, which is a lot of people, really need to be told that you should not use the internet, which I think is probably going to crash the first few days. But they should go straight to 211 and try to get through that system.
Thank you.
That, or if I mean, all it asked me was, are you over 65? And then it said, great to come in. There really should have been, are you over 65? Okay, are you over 75? Over 75, we're going to give you an appointment sooner or with major health conditions.
Thank you. So thank you, Representative Almy. I think you're expressing a number of the concerns that certainly the public has right now. And I just want to be clear, my recommendation to call 211 is simply so that you can talk through the process with someone rather than going through the registration process online. And I know for many people that is easier to be able to walk through it with another human next to you or on the phone with you as you do that work. We understand that, that folks over 75 may be at added risk. We also know that there are risks associated even among that 65 and older group who may still be in the workforce. And so it is difficult to balance all of those different risks together. But my recommendation is to call 211 if you want to talk through that with someone on the phone. The website, we are putting together everything we possibly can right now. All of the supports, all of our efforts are in making sure that both the phone system and the website system will be ready and not crash come Friday and through the weekend. We are dedicating a tremendous amount of resources across state government to do that right now. So that is the piece that we all have not only have our fingers crossed, but we're putting real effort into making sure that we have that ready. Again, to your first question around after getting vaccinated, there is some small indication. And again, we need more data and more time with more people who are vaccinated to see how this really plays out in real life. But there's some small scientific possibility that a person who is vaccinated could still carry that the coronavirus in their mouth and their respiratory droplets, which is why we're asking everyone to continue to wear their masks, even if they are vaccinated. But it was a decision of Dr. Chan and our governor's office that because the risks are so much fewer, much lower, that we would still allow people that have had those 2 doses of vaccine and then 2 weeks out to be able to travel without quarantine or to be able to not quarantine if they were a close contact. We very much encourage all businesses in particular to make their own policies that are perhaps more protective than our policies, and where staff can work remotely. We're truly, as we're all doing right now, calling in from our homes or our offices where we're separate, we want to continue doing those practices because of course that is the most protective. Thank you.
But now that we have a 65-year-old level, the only way that you can get an earlier appointment if you are severely impacted by COVID, if you catch it, is to call up 211.
I'm not going to promise that folks can get an earlier appointment if they call 211. All I'm suggesting is that someone will walk them through the process while they're there. Again, it is complex. We are expecting thousands of people to be calling us early on. This is another place where you may also want to have a conversation with your healthcare provider. So there are, at some point, healthcare providers will also have access to vaccine that they can do within their offices. We are working on the distribution of that right now. I don't have the exact numbers of how much will be distributed to hospitals and healthcare providers, primary care providers, in addition to our fixed sites. So I encourage anyone who has significant questions about their own health and if the vaccine is right for them and how they should access that, to eventually call their healthcare provider. I know that all of our healthcare providers right now, their phones are ringing off the hook as well, and they're trying to provide as much information that they know, given at the time that they know it. The information has been, we've gone quick. We've provided something called Health Alert Networks to all our providers so that they should have the basic level of information and what the plan is. We've been doing weekly calls with our hospitals since the beginning of the pandemic so that we have good communication, but things change quickly. We want folks to make sure that they know that the first day to sign up is on Friday, and we want to make sure everyone has an opportunity to sign up in that 65 and older age group.
Okay, next is Representative Ames. Ames, you'll have to unmute.
Sorry about that. I got to start over again. Thank you. My question is twofold. One is, even after listening to you speak about the priorities and the opening up of 1B in a couple of, I guess, very soon for registration, it's not clear to me what the rules of the game are going to be. Is it going to be a first come, first serve? Is there some other protocol that's going to be in place where you live? What are the variables that are going to go into determining when somebody who calls in is likely to get vaccinated? And the second question is one that flows from a constituent's letter that I received just yesterday, a married couple who are in their 65, 66, 67-year-old bracket. They've served as teachers, they're healthy. They are, I'd say, very upset that they've been moved into the next priority, 1B. While teachers and childcare workers or teachers remain in priority 2, in effect, pushing back teachers to a later time. And they point out that keeping our schools open is certainly for all of us one of the top priorities in this state, getting them open, keeping them open, whatever it is in your local community. So pushing back teachers in this way is very problematic from their point of view. And my question there is whether this question of prioritizing, of defining the groups in a sensible way is open and still being worked on within the circles that you're working in. And I would certainly put in a pitch for the teachers myself. So that's basically it. I think ultimately the supply of vaccination is going to determine a great deal of what can be done. And I know you've mentioned that several times. I wish I had a better understanding of how we go from 17,000 or 18,000 doses today to whatever, a week from now or 2 weeks from now. Again, what are the variables? What's the information that you're on top of receiving or that you hope to receive soon that relates to that? So there's a lot in there. I'm sorry, but this is very.
Yeah, thank you. And I'll try and pick through some of those, the questions that you're asking there. I'll start with supply. Again, we are hopeful that new manufacturers are coming on board. We are also hopeful that there will be an increase in both the Pfizer and the Moderna vaccine that we have right now. We are, the federal government sends the allocations to the states, so we are dependent upon them for those allocations, but having another 2 manufacturers on board is certainly going to be helpful and help us move us closer to that goal. Question about teachers, and this is near and dear to my heart. These are, it goes without saying that these are complex ethical questions that we have wrestled with, and we have wrestled with it from the beginning of the pandemic, and certainly now as the rubber hits the road once the vaccine has been available, around who goes first in line. And I think New Hampshire has solidly come down on the notion that the right thing to do right now is to focus on those who are most at risk for the worst of the outcomes associated with COVID-19. As we looked at that slide earlier where the deaths are among people age 60 and over. We know that many of the schools and the childcare providers in particular who are working day to day, a lot of our schools are remote right now and working hybrid, which we all agree is not optimal for kids or for staff. But we have childcare providers who are working day to day with kids on the floor in a toddler room so that their parents can work. And I know that as the Ways and Means Committee, that's important to you all as much as anything, that's critical to our infrastructure, which is why they are among the only sort of critical infrastructure group that is called out in our plan. We needed healthcare providers called out early so that we had a healthcare system for all of us. So that we would not crash our healthcare facilities and those folks that are most at risk, including our first responders. And then the next group that is an industry group that was called out were teachers and childcare providers. No other critical infrastructure groups were called out in that way. So we recognize that it's going to be a little while. We need to have that supply. We are focusing on the age groups, the 65 and older, again, the people who are most at risk of dying and having the worst outcomes and worst hospitalizations and being on ventilators. We know what group that is. And so that's the decision that many folks came to right now. How we got to that decision certainly is a combination of a few things. One, we have a state disaster medical advisory committee that is a group of medical providers, physicians, and others who help us think about the ethics of this decision making. And they certainly provided a tremendous amount of feedback. And we work with our team of infectious disease specialists and Dr. Chan, and certainly our governor's office to land in the order that we're in right now. I think I lost your first question there, and I didn't write it down, but I think I hit both teachers. I think I hit the supply question.
First come, first serve issue, or what the protocol will be for.
Yes. So thank you for the reminder on that. We are still working some of those things out. So part of the reason you're not hearing a very clear answer from me right now is that those are the details that are being determined right now. And we anticipate that the governor is going to have his press conference tomorrow where he's going to be able to dig in a little bit deeper into those details. So again, the team is working very hard at this minute to make sure that we are successful and that the people who should be first in the line are first in the line.
Thank you.
Okay, Representative Southwick.
Am I unmuted? Yeah. Hi, thank you for all your efforts. I just wanted a clarification. So you'll sign up, which probably means personal information, your email, stuff like that. Then will you basically get an email with an appointment and something you print?
Yes. So you will sign up. You will then find out that you are registered. You'll get a confirmation that you're registered. And then later you will get an email with an appointment date. When we did this with our first responders and the healthcare providers, the ambulatory care health providers, they were our first to go at using this process. And so what we found was sometimes we were able to turn around appointment times very quickly. Sometimes it took upwards of a week or more to get a response with the appointment time. So again, those details, folks are working round the clock right now to make sure that our system is up and ready. We are all committed for it to go live by Friday. And so there will be more details to come. And I anticipate when the governor and Dr. Chan and Dr. Daly do their press conference tomorrow, you will get to that level of detail.
Thank you. And do you have a time for that press conference? Is it usually at 5:30 or 6 or something?
I don't have the time directly. My understanding is it's typically a little bit earlier in the afternoon.
Oh, okay. Thank you.
Thank you.
Representative Bromley.
Yes, thanks, Norm. Real quick, so what's the end game here? What kind of metrics are going to be in place to say that we've won? Is it going to be a combination of cases, deaths, hospitalizations, number of people vaccinated? Is it everybody? Is it going to be zero cases, or has that been thought through yet?
So
I'm not asking to have a crystal ball here, but we're struggling to understand get a kind of a timeline and what would have to be in place for the restrictions to be loosened a little bit and for businesses to really start coming back to normal.
Absolutely. Thank you, Representative Abrami. I mean, you are asking the $1 million question of, when will we know? We certainly know it's not today. We anticipate that the cases are continuing to be high. As I noted, we're in a very different place today than we were this summer, where, we were routinely talking about 20 cases a day, and now we're talking about 600 or more cases per day. The good news is that both the science has gotten better and medical treatments have gotten better. So we can treat COVID more effectively today than we did last year at this time, where we had such high death rates, where everyone who was, at that critical age, we at that critical stage when they were in the hospital. So we know that folks like Dr. Fauci and others have said 70% is sort of the end game for vaccination that people would love to have as a goal for getting vaccinated in order to have some more control of the spread of the disease. We don't know how long it'll take to get there. Again, it's a complex mixture of metrics of supply, of how you get those vaccine here and how fast we can get it out into the arms of other people. But we anticipate, especially with the new variant, that we're going to continue to have some high numbers for some time now. But as we see people vaccinated, we should see those numbers come down. And I think then is when folks like the governor's office and our reopening task force and others are going to wrestle with that question of when will it be time to start loosening up on some of the protocols that we have in place today. We know it's not today. We know we need to get through a lot of vaccine first.
Okay, thank you. It would seem, Norm, it would seem that it would be great if we could touch base with Patricia and others from the Department of Health periodically as time marches on here, just so we get a better feel of where this is going. Thank you.
We'll have her follow up on that. Representative Almy, and followed by Representative Tudor.
Yeah, and mine's quick now, I think. On when we sign up on the website, will we be asked to put in our age and our conditions?
Great, thank you. So you will likely need to put in your age. You will need to put in a birth date, likely. And the medical conditions we're working closely with our healthcare providers because they are going to provide some attestation and have a form that they will need to sign that will attest that this that the individual has the conditions that they say that they have 2 or more conditions. It is unlikely that we'll be tracking the exact conditions that people have, but certainly that they meet the threshold of that medically vulnerable group. And again,
So-
more details on what it's all going to look like, I think will be available tomorrow. And again, I apologize for not having that information today, but we are literally working on it as we speak so that it's ready to go. And I don't want to promise something that or describe something that may change between now and Friday.
So we are going to put in our medical providers at least.
If you are, if you have you fall into that medically vulnerable information or medically vulnerable category. Now, if you are simply age appropriate, you will not need to provide your medical information. So if you are 65 or older, that will be good enough as the vaccine phase checker, as you used on the website does. You hit 65 plus and you're automatically in group 1B. And this is also in part, we want to reduce the burden as much as possible on the healthcare providers as well. We want them to, we know that this is a huge lift for them, and we are very grateful to their partnership because they now have to be working with their panel of patients, especially those who are under 65 who have those medical conditions. They want to be able to make sure that they can take care of those folks as well as their population that is 65 and older.
Representative Tudor.
A great presentation. I'm all set. Representative Almy got my question answered for me.
Okay. And that was the last one. Well, Patricia, I mean, sure had just number of questions.
Representative Major, I'm sorry to interrupt. But Representative Edwards raised his hand in the attendee panel. I know we're quite a way over time, but I just wanted to bring that to your attention in case you wanted to accept his question.
Representative Edwards.
Just a moment. Okay, Representative Edwards, you can unmute and speak.
Okay. Ms. Tilley, it's always a wonderful event hearing you. You use the term partnership with our healthcare providers because we know how much workload that's getting put on them. I just would like you to know I've had 3 different family practice type people, 1 PA and 2 doctors, reach out to me and say that the workload being imposed by the vaccination program is intense. It's breaking them. It's costing them a lot of money. So it's good that you're saying you're going to do what you can as a department to reduce the workload burden. But I just want to hear a little bit more about the appreciation that this isn't a partnership. This is us jamming work on them that they can't refuse.
Thank you, Representative Edwards. There is no doubt that this is burdensome. We know that, and I use the term partnership, it is not a euphemism. It's true appreciation for the work that we can't do it without them. I think we all share the notion, however, that we want to get folks vaccinated and we want to prioritize those that are medically vulnerable. And we have to have some process to do that. So again, part of the conversation of reducing to 65 plus is that may relieve a little bit of burden, again, to certify whether folks are medically vulnerable or not, because they meet the category. If you're 65 and older, you check, you're in that group. We know that people have intense relationships with their medical provider. So we know that even if we said, don't call your medical provider, people would still be calling them up on the phone because we have such long-term relationships with them. And especially those of us that may have multiple medical conditions, we want to know from our medical provider that this is the right thing to do. So we appreciate, I don't know how much more I can say that we appreciate the work that is in front of them right now. It is a burden for all of us to move forward, to move quickly at the pace at which we are moving during this pandemic. It has been an extraordinary
So
time.
thank you. In the interest of time, I'll just say you've answered my question completely. Thank you.
Thank you.
Okay, any further questions, Jen?
I don't see any more hands, no.
Okay, so we thank you, Patricia, and I'm sure that you're going to get a lot more questions before it's all over.
And as I said, I encourage everyone, there will be more information available tomorrow when the governor has his press conference, and Dr. Chan and Dr. Daly will be able to lay out a little bit more of the process. You got me like a day or two too early to have all of the details available for prime time.
Okay,
thank you.
For the members that are members of the House Ways and Means Committee, next Tuesday and Thursday, we will have another virtual meeting all day. And on the 26th, which is Tuesday, we'll be meeting with agency heads starting at 9 o'clock with the legislative budget assistant, then the Department of Revenue, the lottery, liquor, then lunch, judicial branch, Department of Health and Human Services, Secretary of State, and Department of Justice. Then on Wednesday, starting at 9 o'clock, it'll be the Insurance Department, Department of Safety, Department of Transportation, Fish and Game, lunch, Department of Administrative Services, Treasury Department, Department of Labor, and Department of Agriculture and Markets. And that'll be our schedule for next week.
Representative Major, this is Chris. Could I just interject for a second?
Yes.
On Wednesday, you took the Department of Agriculture and Department of Labor off the schedule. We were just going to have Administrative Services and Treasury Department speak to you.
Okay, that's right. We're going to end with the Department of Administrative Services and the Treasury Department. Yes.
And just so members know, as we get the presentations from the agencies, we've asked them to provide that by Thursday this week. What we will try to get them posted on the same website page that the presentations were for today and yesterday. And we will have an email sent out to you as well to let you know that they're available. As you've noticed with the past 2 days, not all the presenters get us everything on the days that we've asked for them for different reasons. So we will get them up on our website as quickly as we can. And that's all I have for the moment.
Okay, and then just for the future, on the 2nd and 3rd of February, we plan on having agency heads in again. I'm sorry, agency heads on the 2nd, and then a work session, we'll start that on the 3rd of February. And that's it for right now, then we'll go from there.
Norm, it's Matt.
Yeah.
Aren't we gonna do bills on the 28th and on the 4th? Is that something you've announced or going to announce?
Okay, right. The other day I mentioned that on the 28th for the Ways and Means Committee, we'll be having hearings on 1, 2, 3, 4, 5, 7 bills. One is an early bill, and the others are primarily associated with the budget. The bills that we're going to be hearing on the 28th is House Bill 10, House Bill 15, House Bill 210, House Bill 281, House Bill 353, House Bill 533, and House Bill 568. And that will be a hybrid arrangement. We have 3 other days, the 4th, 11th, and 17th of February. that I'm asking for, but it hasn't been finalized yet, where we plan on hearing all the rest of our bills. There'll be either 6 or 7 bills each of those days. Those are the bills that are currently in committee. We will be getting additional bills in the committee because anything that has to do with revenues that went to a policy committee ahead of time, if they pass the session, will come to us as the second committee bill. Now, the bills that we'll be hearing initially, we may have to have a committee as a whole to go into these bills because there's questions and things that need to be done with them. It's recommended that we do not go to subcommittees because they don't have enough room to do subcommittees. So we will bundle them together in committee as a whole to deal with them, where we normally would have as subcommittees. And we'll go from there. And then as we can, we'll do our executive sessions. What we also want to do is try to identify those bills that we feel need a lot of work and that work should be done, would be candidates for retaining so that hopefully next year we'll be back in a normal environment and we can do these in the correct way. All right. So we have our work cut out for us. The goal is to come up with our revenue estimates shortly after the governor presents his budget with revenue estimates to the finance committee. Once that happens, trying to making arrangements to have their governor's budget director meet with us to explain his revenue estimates. So we'll have some intelligence on what he did, because in his revenue estimates might be revenues that are more than what current law is. When we do our revenue estimates, it's just based on current law, so that we can pull out of his revenue estimates things that would require rate changes or additional revenue sources. And we'll get that information after the 15th of February. Any questions? If not, then
I just have one.
Larry has a question.
Yes, Representative Model.
I just got an email saying there's a training tomorrow morning for committee chairs and techs. Is tech the thing I signed up to do?
Yes, it is.
Oh, okay. Thank you.
So, committee clerks and techs?
It said training for committee chairs and techs.
Oh, okay. All right.
Zoom training for, yeah.
I was thinking of Representative Bernstein, because he missed a training for clerks because we had this going on. So.
Yeah, I've been in contact with the clerk and we're going to work out an alternative arrangement.
Okay, good. So tomorrow morning is, okay, all right.
And Representative Ullery has a question as well, Representative Major.
Yes, Representative Ullery.
You said earlier that you will be sending this stuff out by email so we can put it into our Outlook calendars and where the meetings are going to be held and how they're going to be held and all that lovely stuff.
Right. The meetings next week is just strictly virtual, except for the hearing. And I'll get a hearing. I talked to the clerk today and they're working that out. So, and once I find out what the hearing room is going to be, we'll notify you by email. And it should go into, it should be in the calendar coming out this week. Any other questions? All right, thank you.
Thank you.